You're all very welcome to Practice News, the first Practice News of 2023. So we're delighted to have you here. I'm here in Dublin. Jeremy is joining you from our Belfast office, live from our Belfast office. And so it's a packed show this morning. We're delighted to be sponsored, as always, by Accuvest. Accuvest is an Irish-owned, fee-only pensions and investment advisory company. So I say we're always delighted to have their sponsorship. To move straight into our headlines this morning, without further ado, there's a lot going on there. First of all, Jeremy's going to give you a few reminders about alternates, about CPD, just to make sure that if you are auditing, that you are doing it right. And then ISQM. Okay, it's been in since December, but where are you at? Just no harm, just quick refresher, just to remind you it's still in the background, and you still need to be thinking about it and thinking about what you have to do in 2023. So Jeremy's going to talk to you about that, as well as all the resources that we've put up for you in practice consulting and in the broader institute. PQAs, we are going to be issuing a new version of the PQAs, so I'll talk to you about what's in those. So do watch your inbox, as we said, they are going to be new, and you need to use them in 2023. Jeremy was instrumental in putting together the technology conference, as with others, of course, but I know Jeremy was heavily involved in that. Thank you very, very much for doing that. And he's going to give you a few takeaways from that. Tax, always a huge amount happening. We're going to give you updates in ROI tax. Also, there is a proposed update to FRS 102, our core standard. If you are if you're doing accounting at all, it's all about FRS 102. So any changes to FRS 102 are going to impact. And I think when you see what's happening with leases, you're going to be thinking that this could well have a major impact on a lot of your clients if the proposals are carried through to the final standard. So we're going to give you an update on that. Sustainability, the CSRD, the Corporate Sustainability Reporting Directive is now in place. So we're going to tell you what that means for you. And once again, I think it's going to impact far more people than you think. It's going to ultimately impact all large companies, and indeed large groups are not that large anymore. So I think an awful lot of small and medium-sized practices have at least one large client. So listen up, this is going to be important for you and your clients. We're going to be talking about the Members in Practice Committee and what it does for you. We're delighted to have the chair of the Members in Practice Committee, Maeve Hunt, with us today. So we're going to be talking about the Members in Practice Committee. And finally, we're going to do a bit of crystal ball gazing into 2023. We're already a month into it, but what is the rest of the year going to hold? We're going to do our best. Now, a packed session, and we're ably assisted by a number of people. So Jeremy's going to just give a brief introduction to those people before we crack on.
Indeed, thanks, Conal. Yes, a packed session, and I think actually our biggest show by number of presenters as well. And I'm going to start here looking at my screen on the top left-hand corner and work my way around. And I'm going to take actually our advocacy and voice team together. So starting with familiar faces, I'm sure you all, I know they've been on Practice News in the past. We have Dee Moore, who is the lead, our professional accounting lead, Susan Wozni, our sustainability officer, and Mike O'Halloran. And our advocacy and voice team, guys, if you're not familiar with it, are the team that represent the interests of institute members with government departments, with regulatory bodies, and so on as well. So, for instance, Mike is going to tell us about the periodic review of FRS 102, and also there'll be an opportunity for the institute and for the members to have their input into the latest draft of it. And Susan and Dee as well will be dealing with the CSRD, the new Sustainability Directive. We're going to get an update on that and all the guidance that's available there. So we're really looking forward to actually have the three guys on board. Next as well, we're delighted to have Gerard back to give us the ROI tax updates. Lots of different happenings now, be it on TVES and also with relation to just implementing the Finance Act 2022 and Budget 23 and so on. And as Conal mentioned as well, delighted to have a recording from Leon Doran, our UK tax lead, towards the end of the show. Always very informative and a lot happening on the UK tax side as well, particularly changes with relation to making tax digital on the income tax side deferral, which I'm sure has been a relief for everybody else. Hopefully you all know myself and Conal from the practice consulting team, so I won't dwell too long, but great to be with you. Now that's our institute actual guest here this morning. We have two other guests as well, external guests. So Conal, if you can click to the next slide. And I'm delighted to be joined by Maeve Hunt. I'm sure Maeve is a familiar face to many of you. I'm sure many of you know Maeve. She is currently our Institute Members in Practice Committee Chairperson, also a council member of the Institute, and has previously been, and I think her name would be behind me on the wall here, as a very recent actual Ulster Society Chair in 2020 and in 2021. And as Conal mentioned, Maeve is going to talk to us about the role of the Members in Practice Committee, and also be part of our discussion on the challenges and opportunities ahead for 23 for those in practice and for your clients. So Maeve will be with us about 11:15 or so. Now, as well, we're delighted, as you mentioned, Conal, to have Damien back from AccuVest, and Damien is going to give us his insights with relation to the wider economy for 2023. So we'll be part of that discussion with myself and Maeve and Conal, and very much, as I say, challenging time, be it for investments, but also some tips as well with relation to pension planning. So Damien, great to have you back on the show as well, and looking forward to talking with you later on. So that's actually all of our guests here today. Now, as Conal mentioned, we're delighted to actually have a record number of attendees actually booked on this actual webinar. So far we're approaching 300. I can see actually live people here. We have 550 bookings. As you can see, every county on the island of Ireland are represented, and well beyond that as well. One tip I'm actually going to mention here on one of the graphs is we can see a lot of people are categorized by our actual institute membership as being members in business, about 14%. We think that actually is probably because they're incorrectly categorized. And so if you're here today and you haven't been into the My Account section of the actual website, the Institute website recently, go in and check that you're properly categorized, and consequently that you're getting all the relevant practice consulting emails, such as the actual Practice Matters bulletin that I'll talk about in a minute, and so on as well. So that's one tip. The rest of that graph, and there's lots of good graphics there, I'll leave you read yourself. Only if you can click ahead again. And yeah, our disclaimer. Well, listen, very detailed notes here, and I always say this, be it our technical webinars or one of these webinars here, this is just a high-level overview of so many relevant topics. A lot of guidance and detail for you to read, be it the CSRD itself, be it FRS 102, FRED 82. So always get into the detail if you're trying to have an issue that you're trying to apply for yourself. That's as much as I'm going to say in the disclaimer. Always, of course, required to have it in any webinar we have. So, Conal, if you can click ahead again. And time for the news items. And as you mentioned, I'm going to give you a couple of updates. And all these, not all, but most of these updates come from Practice Matters. I'm sure all of you here will be familiar with Practice Matters over the years. It used to be a version until about 2 years ago. Then we started to send it out by email. And the latest version would have gone out, I think, about the 1st of February, so about 8 or 9 days ago. And essentially, you should have got it to your inbox. If you haven't, it could be down to that issue I mentioned previously, where you're incorrectly categorized as a member of business and not getting those updates. So please do go into the My Account section and check that out. There's also previous past issues are available to download there from February 23 back at the link there if you have the PDF. So, Conal, click ahead and I'll tell you about a couple of my news items here are audit focused today, but still, even for a non-auditor, relevant to know about as well. And a couple of these items, they're just coming to a head now. We've mentioned them before, but you need to actually, if you are affected by these, to seriously look ahead now and address them. And the first one is a requirement has come in from IASA. We've been heralding this for about a year or so now, is that if you're a sole practitioner and a sole practitioner who is an auditor, sole RI, there is a new requirement that if you're on the ROI, Republic of Ireland Audit Register, you are required from April 23 to have an alternate in place. Again, we know that there isn't that many actual practitioners impacted, but again, of course, in the small practice community in particular, and it does apply even if you're in Northern Ireland or in the UK, once you're on that register, you actually have to have the alternate in place. Again, it's coming to the 6th of April 23, and I think many of you would have recently received your annual return, would have been asked if you were impacted by this, and that we'd identified you were a sole practitioner RI to confirm you had an alternate in place, and you will be required to confirm to the Institute that you have that alternate in place by April 23. Now, if you're still working on this, there is a very useful professional standards FAQ document there to go through what exactly is the role in being an alternate to meet this requirement, the wider role in being an alternate, and some tips as well if you're putting in place an alternate agreement with another actual RI and practitioner. Really good document, so please do read that and put together by a professional standards colleague, Karen Flannery. If you can click ahead to the next thing, that's as much as I'm going to say about that. And of course, if you contact professional standards if you have any queries. Conal, you're going to say something else.
No, I was just going to say something. We're it has been asked, do we have a register of people who want to sort of match up alternates, and we don't. It is a very personal thing to be somebody's alternate. It is going to, if you are somebody's alternate, should anything happen to them, it is going to cause you serious inconvenience to step in and to look after their affairs. We think it is something that people should reach out to a personal contact on. So I don't know, if you can't think of anybody, sort of go back and see people you were in college with who have gone into practice and have a mutual arrangement. But we're not matching people up. I sort of just to.
You're right, Conal. Valentine's Day is coming up, but we're not gone into matchmaking. Unfortunately, you're right. Your best place to find your own partner.
Fair enough, but look, I mean, I think it's the right thing to do, because we've been there before, and we really we see what people have to do when they have to act as alternate, and it's fairly extensive, and it's not to be taken lightly between two people, but it's something you should do, something you must do. But I'd ask people to reach out to their personal network to find somebody who's appropriate for their role.
Brilliant. Thanks, Conal, for that. There's another actual reminder to you as well, and I'm sure something that all of you who would be RIs as well on the Irish Audit Register, another IASA requirement that has been heralded for about 2 years now. We began to outline this to you back in early 21, and it came into play formally from January 22, where if you are on the Irish Audit Register, no matter your location or the amount of audits you do, you actually are required to actually undertake specific RI auditing, financial reporting, and company law training in a year. And you're meant to plan this out, document what you have done, and you will actually have been seeing this in recent weeks, where professional standards are required to actually send you a declaration to confirm that you have met those requirements for 22, and this will be an ongoing thing in 23 onwards as well. And be aware that actually, as part of audit monitoring visits going forward from this month onwards, professional standards will be checking that RIs are actually doing and keeping records of the appropriate training. Again, we can realize that this might be a new thing and something that you're a little bit uncertain on. So there's a lot of actually good training and materials available if you want to click on the exact requirements, the first link there. But also, Conal, if you can click ahead to the next actual slide here, our colleagues in professional standards, Cathy O'Hanlon, has actually put together a very informative presentation, about half an hour long. There's other materials on the website as well about what exactly you need to do. I know in our past courses, Conal, and we'll keep doing that as well, or if you attend an auditing or a financial reporting course that has an ROI aspect, which most of them do, we fill out an actual, give you an Excel spreadsheet and a template to actually do, and having that recorded in, that will actually build into your overall work plan here. Again, if you have any questions on this, and naturally they might have been prompted by that declaration coming out, there's a special email address you can contact professional standards on there at the bottom of the screen. So hopefully that will give you more information on that. And again, it is something that's coming to a head now as we begin 23. Conal, if you can click ahead again, my final piece here is ISQM. Look, for the auditing community, it was a big thing for 2022. And we were involved in pushing out our own resource pack, which has been very popular and still is there, with templates and example risk assessments there. And we did a number of webinars back in late in the autumn there, between October and November, very well attended and so on as well. I know as well that ISQM is something that it's not like the old ISQC1 on the relation to quality management of your audits. Firms have been required to design, implement, and to begin to operate a new system of quality management with relation to audit and assurance work. But this is something that you'll have to maintain going forward as well. So we realise that firms will need assistance on this. You can't simply do up a set of procedures and park them there. You'll need to keep updating it depending on your own risk assessments and your own firm requirements. So with that in mind, we're actually hosting another webinar to help out firms. And we do realise as well that certain firms might be, I'd say, further along the road ISQM implementation than others. And so this webinar, wherever you're at, if you're really just still starting out and a little bit behind, or if you're trying to keep it maintained for 2023, it's on Thursday week, the 23rd, and you can learn more on it there. And if you're really looking to learn a bit more about ISQM and its implications, there's lots of free materials on the Institute website, technical alerts releases. There's IASB guidance internationally, and there's also a number of short IASA videos as well, which are great for anybody in practice to learn up on. That's as much as I'm going to tell you on ISQM. Conal, I know as well, yourself and Michael, our colleague here in Practice Consulting, have been working on the PQA updates, or you will be working on them. So tell us more.
Absolutely, yes. We're working on a PQA update at the moment. There's a few changes to come in. I mean, the changes are going to be evident in them, but I don't think they're going to be as extensive as they might be, because we tend to front load the PQAs anyway. We tend to sort of ask ourselves as we're drafting the PQAs, what is best practice and what's practical for small firms and in smaller audits to actually do in order to protect themselves and to do good audits, to do them efficiently. So that does tend to front load them, in other words, to have some of the requirements then already in there as steps in the PQAs. But that said, there are going to be changes. The hot file review will change to reference ISQM2, which covers that. There's extra declarations required by the new version of ISO 220. The section C, the accounting records piece, is going to have a lot more in it because there's more requirements there from ISO 215, whether you're in the UK or the Republic of Ireland. The audit planning memorandum is going to have a more scientific approach to risk. It's going to have a risk spectrum. It's going to have sources of risk, the various different sources of risk. And we're going to just look at the aid memoir, polish that up, just get it a bit more clarified on a few points to help you. So quite a lot going on there in the PQA update. Hopefully going to be helpful to you. As I say, we're going to highlight in it what's changed in it, and you should be using that as soon as it comes out. You should start using it on your audits. I know, I mean, and we work with people, and we know that it's always a temptation, especially with, say, the audit planning memorandum, to just roll forward last year's audit planning memorandum, but you can't really be doing that when there are actually extra requirements that we've built into the new ones. So there we go. That is the PQAs. We also just want to say, in practice consulting, we are hiring. We would like some more help to help you. So we're looking for, the role is called a practice consulting accountant. It's a part-time permanent position if you are interested. So the idea is to sort of follow Jeremy, myself, and Michael, and Catherine going forward, who are there to help members to listen, support, advise, all those things that we do, so that we can help you better. So look, the ideal candidate would be somebody who had 10 years plus experience. So there's a live link there in the slides that you were given if you were interested, or if you know somebody who might be interested in that. Now that is that. So we are now, and hopefully we'll be introducing somebody to you at some point. So we're looking forward to that. Now I'll hand you back to Jeremy, who's going to talk to you about the technology conference. Indeed, and before that, somebody's asked when will the new updated PQAs be available. I think later in the spring, Conal, is where we're guiding. Would it be appropriate to say, it's hard to put a time in it, but definitely March, April time? Probably sooner than that. Sooner than that. Oh, great. Well, sooner than April. Would certainly hope. I would say it's going to be March now, but we won't be leaving it any later than that. As soon as possible. As soon as possible. As soon as possible is what we've got. We'll have a date for you. As soon as we've got a date, we'll let people know, so that people can plan their lives accordingly. Indeed. So if you're the audit compliance principal, as a person who's registered for the PQAs, watch your inbox, as I said in the initial headline there. You will be getting details of when it's available and when to download and so on as well. Well, listen, that's enough on audit. I just want to give you a quick reminder before we get on to tax on the technology conference. The conference itself is, an annual event, usually our kickoff to our CPD schedule for the year, and it was held online again on about 2 weeks ago, on the 25th of January. I'm sure many of you may have attended. Again, it's usually a morning session, 3.5 hours. And this year's events, we had a great input, and I'd like to thank the chair of our technology committee, Anne Brady, and also the other members for their input in devising the teams, the topics to cover, and so on as well, and the outline for the morning. And we looked at the threats and opportunities, as we're now in a new world post the pandemic, and we looked at such areas as the future of work, process automation, collaborative online working tools, and cybersecurity. And if there's a couple of things coming from me, as I say, is with relation to with Pat Larkin and the other guests talking about cybersecurity. No matter what the size of your firm, small practice, the clients you're dealing with, it's not all the big players, national bodies, and so on that can be targeted for ransomware, for different things. So do put aside time if you can to check on the, security of your own systems and networks and so on as well, and to ensure that you have all the as much checks and balances there as you can have.
Also as well, there were some great tips from staff from Joseph with relation to online working tools. I learned a lot about communications and maybe stuff that's coming down the track that can be great for internally in your firm, but also dealing externally as well, and more than the traditional Teams and Zoom that we might use. Look, guys, if you missed it or you didn't get all of the events, there's a full recording available at the link there. That's as much as I'm actually going to say about it. Now, as we're a couple of minutes behind, that's our news items. So hopefully you found it useful. Ronald, if you can click ahead, and I'm delighted to be joined from Cork again, live, Gearóid. Again, great to have you back for 2023. And I know, Gearóid, it's on the tax front, there's never any rest. I know the autumn is a very busy time with the budget and with the Finance Act, but of course there's implementation of those, and of course the TBES, the Energy Support Scheme, I think has been keeping everyone busy as well. Without further ado, I'm going to hand over to yourself. You're very welcome, and you have the stage.
Thanks, Jeremy. Thanks for the introduction as always. And yeah, as you say, good to be back here for the first practice news webinar of 2023. And yeah, as you said, tax continues to roll forward and moving on from budget. We're looking forward now to 2023, as I say, and implementing some of the measures as well as adapting to the measures that have already taken effect since 1st of January 2023. So I suppose with the year ahead, just to mention at the outset, we've included a question on today's follow-up questionnaire that will be sent around after the webinar. And one of the questions we're now including is an opportunity for anyone on today's call or today's webinar to include a single issue, so a single issue per responder in your interactions with revenue, or maybe interacting maybe with government departments as part of the tax compliance process. And it doesn't, as I say, say in government broadly, because if you're interacting, say, with the Department of Social Protection on a particular issue or things like that, welcome feedback on that as well. But I guess why we're limiting, why we've said we'd limit it to just a single issue per person is, I suppose, we're all aware that there are many things that need improvement at any one time in any area of government. So we all could create quite a Vasanta's list depending on our particular area of expertise and practice. But I suppose what we're hoping to do is, if we can identify a single issue that's recurring for people, that's what we're hoping to do. So just when you see that question today, if you do respond, that's I suppose the intent behind it. Just to mention at the outset a bit more about TALC. TALC is really the Tax Advisor Liaison Committee. This is where ourselves, the Institute of Tax and the Law Society meet with Revenue to discuss various tax technical and tax compliance matters. And I suppose, for those not as familiar with TALC, this is, I suppose, the opportunity where we get to bring your problems directly to Revenue and have some meaningful conversations. As always, some things we do reach maybe a dead end at a certain point of time where we say, look, we bring the issue, but for now, there isn't the capacity or the scope to deal with it, because there's everything's important, but not everything's urgent. And the same in our offices, we have to manage workflows accordingly. Obviously, Revenue are on a similar it's a similar business in that regard. But I suppose, yeah, we are really, TALC does allow us to at least start moving things along the agenda. So that I suppose, yeah, just wanted to mention that. So as I say, welcoming the feedback on that over hopefully after today's session. So now just to move through the actual slides, that we have up a few points in the slides. So yeah, look, there's been an awful lot of updates since Christmas. As always, there's been a huge amount of TDMs published, but look, just picked out some of the highlights here, that we feel that would be the most benefit to as many people as possible. But as I say, really important to just, if you're in a specific area, maybe a niche area, just to be aware that there has been an awful lot of guidance published. And we've mentioned all the different bits in Tax News Weekly. Don't have the time today to go through each and every update, but as I say, we'll try and cover them now. So starting with ROS, there has been some updates to ROS. I suppose the first to mention, Revenue is no longer supporting access to ROS via Microsoft Internet Explorer. So for those of us using the Office suite, Microsoft Edge is the new I suppose browser from, I'm not sure how new it is, but to me it's new anyway, and I imagine to many of us it's relatively new. But as I say, Microsoft are no longer supporting Internet Explorer, so I'm not being a tech expert, but I presume that creates security issues because they're not updating it weekly. But as I say, all other browsers are supported to the best of our knowledge here. You know, you've Firefox, Chrome, and all the different the different browsers available to you. Also to mention, the 2022 Form 11 has been updated both online and on the ROS preparation facility, the RPF. So we made revenue aware of an issue with the online Form 11 in early January, and I think around the 24th of January, so the third week, just after the third week in January, that form was updated, as I say, both online and on the RPF. So if there's been any if people have been trying to file an early Form 11 and encountering difficulties, hopefully that should be resolved now. But again, this is one of those things. If you are continuing to have issues, please do let us know on that one. So now moving down onto the rent tax credit. So for those of us who are renting, this is obviously a very valuable credit, and revenue are starting to pay out quite significant numbers or amounts now under the rent credit. So what we have some figures to date there. To date, there's been over 485,000 income tax returns processed for 2022. So these would be Form 12s, of course, including our Form 12s via my account. And there's been 120,000 claims for rent tax credit. So that's quite significant at €500 a go. So of these, 90% are claiming from, in respect of RTB registered properties. 10% of the claims are for digs and rent room. And of the digs rent room, I think 88% are PPR and 12% are for attending works courses. So only 1.3% are claims for rent payments on behalf of children. So there was a bit of discussion around this at finance bill time, but again, it seems most of the claims are for people in their in their principal residence. So because since this was introduced by Finance Act 2022, Revenue created a new tax and duty manual, Part 150111A, and this outlines the conditions which must be met. So I know we've discussed these at previous previous webinars and at various tax events, especially in the last few months. But I suppose just to recap, the key condition is RTB registration. There are certain exemptions to that where you're living in someone's. If you're renting under PPR relief, or you're renting in certain other scenarios. But as I say, PPR for the majority of us, RTB registration is a key requirement. As mentioned there, the statistics, claims have been processed now for 2022, so you can go into my account if you're a POE filer and claim the credit that way, or you can claim the credit when filing your 2022 Form 11 if you're if you're self-assessed. The credit can be claimed for 2023 in 2023, and to mention that you can. If you make the claim, it will be apportioned. It can be apportioned over the year, so equally across the year. So again, a kind of decision for each individual. Do you want to use it to even out your tax over the year, or treat it as a saving at the end of the year for whatever you want to use your savings for, obviously. So that's just a quick update there on rent tax credit. As always, the tax and duty manual will contain all the necessary information, and Revenue are processing claims relatively quickly for the rent credit. The big piece that came, one of the big piece there, I suppose it's relatively everything can be big, but one of the, I suppose, common concerns coming out of the Finance Act 2022 is the new section, or the enhanced employer reporting requirements. So this was, as mentioned at the time, this came in under everyone's radar insofar as it just wasn't flagged. So I suppose at the time there was concern of, why hasn't it been flagged in advance? But I suppose the inclusion in Finance Act, it was, as it turned out from subsequent discussions, I suppose is the initial announcement that this is coming in. So this year, Revenue will consider how best to implement these new reporting requirements. We're expecting them to come in from 2024 onwards, so it'll be applicable from 1 January 2024 onwards. That's the current expectation. It will initially cover, at least per Finance Act 2022, and pending no further update in Finance Act 2023, it'll cover small benefits, e.g. vouchers. It'll cover the remote working daily allowance and travel and subsistence. So obviously, presently these aren't reportable at employee level. You might report them, in accounting and certain other places, but as I say, there's no requirement to report at the individual level. That's going to change. That's the plan. These small benefits are like the vouchers that we talk about, the 500 or 1,000 euro, depending on how much you're giving your employees, the remote working daily allowance, and the travel and subsistence. So typically, if you consider the travel and subsistence, I suppose employers are already required to maintain these records, but obviously to put the reporting of these on a legislative footing is a different requirement altogether. And we're having those conversations with Revenue presently, but we haven't had, I suppose, a detailed sit down with them yet. So we're expecting that at TALC, I've mentioned earlier, in the coming weeks and months. Revenue wrote to agents, employers, and software providers to seek their input. So there was an initial information gathering exercise just on how best to implement the new reporting requirement. And it launched a survey on how employers record such benefits presently. And this survey was closed on the 5th of February. So we'll hopefully see the results of that survey and some of the insights that have been gleaned from that survey in the coming weeks and months. So to mention, in recent correspondence received from Revenue, it was suggested that the items outlined above, so reporting of small benefits, remote working, and travel and sub, that these are reportable under what they've described as an initial phase of a multi-phase project. So we're not quite sure what this means yet, in the sense of this, we asked tentatively about some more insight into this project, or what this multi-phase project may entail. And we can't share any insights as of yet, but I suppose it's important that we're having these conversations now rather than a few months' time, because these enhanced employer reporting requirements, Revenue are very serious about implementing these. As I say, because it's now been enshrined in Finance Act 2022, obviously it means there's serious discussions are now required on how to implement this and whether there should be limits on implementation. So certainly we'll be continuing to discuss this with you, and we'll be advocating very strongly on your behalf about the different the problems this causes, particularly for smaller businesses, and also it's sort of counterintuitive with these small benefits are not reportable for a good reason. So the reporting of them sort of flies in the face of the spirit of these things. We've communicated this, but as I say, we'll continue to engage with Revenue on this and keep you updated. I can see a lot of comments just popping in there already, and again, expect that, not surprised. We're as I say, we're obviously in the same boat here, advocating on your behalf to try and figure out why are they being brought in, and try to explain to Revenue the frustration at this. As soon as we saw this in Finance Act, and as soon as all of you on this call saw this section, the frustration is immediate, because it's for some, again, just to reiterate some of the comments coming in, it's frustrating. It's going to fall back on us as accountants. So we continue to liaise with Revenue in that regard. So I know I'm kind of conscious of time, so I'm going to try and slide through my next few points. Just to mention, Revenue has updated the SARP manual, the tax and duty manual for SARP, for effect the extension of SARP to the end of 2025. And the guidance has been amended for the new qualifying requirements applying to assignees who arrive in the state on or after 1 January of this year. And it also includes a copy of the new form SARP 1A. So as mentioned previously, the new requirements for SARP, that you need to be certified within 60 days of arrival in the state. You need to have your PPSN. Previously, you just had to show that you were applying for your PPSN. We've mentioned this before. So there were scenarios where, say, a SARP employee arrives in the state and they might apply for the PPSN, but they may not receive the PPSN for 6-7 months, sometimes longer. And obviously they're being emergency taxed the whole way. So there's no this risk of no loss of, there's no risk of loss of revenue to the Exchequer in that regard, the opposite. But the new requirement came in, I suppose, Finance Act 22 brought in this requirement for the PPSN to be included in order to claim SARP. And if you don't meet the qualifying conditions for SARP within the time frame, then there's a cliff edge to the relief. There's no way of claiming the relief subsequent or after the deadline. So it's very important for people claiming SARP now that you commence the PPSN process ASAP. And again, the Department of Social Protection came in to give a presentation on this before Christmas to TALC, and mentioned that they've significantly reduced waiting times for PPSN and done quite a lot to improve the system, including recruiting extra bodies and things like this. But they also mentioned where delays are encountered in receiving PPSNs from the DSP. The DSP suggests that in exceptional circumstances, individuals correspond via the client identity services and put a marker in the subject line to denote that the request relates to SARP. So it's a SARP delay, etc. So just keep that in mind. Say if you've made the application, you haven't, on day 1 and it's day 30, and you have, or day even 20, you haven't heard anything day 21, then consider the client identity services. Similar process to the exceptional contact facility that we've mentioned before. So quickly here, review of revenue opinions and confirmations. Again, just to mention, the taxpayers who wish to continue to rely on an opinion or confirmation issued by revenue in the period between 1 January 2017 and 31 December 2017, and you should continue relying on that on or after 1 January, you should make an application for renewal or extension on or before the 31st of March 2023. So again, just to keep in mind that revenue opinions and confirmations do expire. Supports for on the supports for refurbishing vacant property. The Department of Housing, Local Government and Heritage has published a useful webpage detailing all the supports that are available to people that refurbish vacant residential properties, including various grants and tax relief. So I've had been looking at this particular page myself, and it's very useful, just a helpful resource just to set out the range of options available to are the supports available for refurbishing vacant residential properties. So, yep, again, just to be aware that resource is there, and we can send on a link as well in due course. I'll pop a link actually into the Q&A in a moment. So just the update on the TBES. So the temporary business energy support scheme. So this was obviously one of the flagship supports that was announced on budget day 2020-23, and I suppose the hope was that this was going to have quite an impact in offsetting some of the rising energy costs on businesses. And I guess, having spoken to many members before Christmas and receiving feedback, I suppose, from members since Christmas, that the feedback is underwhelming, I suppose, in terms of people's response to the scheme. I suppose, in terms of just the actual, first and foremost, the repayment isn't significant. Too, for many people, they're struggling to actually meet the threshold, so the energy increase threshold. And then also, I suppose, on top of that, it's just it's a cumbersome process people are finding, and practitioners are finding it's cumbersome. And I say people filing are finding it cumbersome. So we wrote to the Department of Enterprise, Trade and Employment last week. So we wrote a letter just advising that the TBES needs to be updated. And so we mentioned some of those issues, as I say, in particular, that the energy cost threshold needs to be reviewed, and also to consider businesses that are powered from unmetered sources. So obviously the big one there, LPG, and certain other sources like that. We're asking government to consider some mechanism to enable such businesses claim, given that many businesses across the country operate from unmetered power sources, or at least get much of their energy from unmetered sources, which again impacts the 50% threshold. So you would hopefully have seen there that the government, revenue rather, announced an extension to the January cutoff for September claims. So the legislation provides that a claim must be made within 4 months of the end of the particular period you're claiming for. So the September period is January, the October is February 23, etc., that's where it's moving on. But given that there's been issues with registering, it observes, and there's been I suppose there's quite a lot of revenue. Yeah, revenue notice quite a lot of businesses have registered but not necessarily submitted their claims yet. So they're currently they're accepting claims for September still, even though we're well into February. They haven't given us a hard cutoff yet, but I guess the message is you can keep making a claim. So until we hear further notice, September is still in play. Some of this, again, the statistics I suppose that we have at the moment, just under 6,000 businesses, so 5,793 businesses have fully completed the claims process with approval for claims valued at about 17.5 million, of which just over 13 million has been paid out. So I think the fund is about 1.5 billion euro. So the payout to date certainly is underwhelming. Some of the things maybe suggesting why that's reasonable is perhaps that the energy increase hasn't really kicked in since October. So if a lot of those claims are relating to September, hopefully in October, November, we'll start to see an uptake in claims. I think October to May are considered the heating months of the year per the SEAI. So yeah, I suppose we might, maybe that's having an impact on it, but as I say, it's still significantly under what we would have expected to see up to Christmas. As I say, a little under 18 million of approved claims when you've got a 1.5 billion euro fund is, significantly less than was expected. So as I say, we're going to follow up with the minister in due course, but we have written to them, as I say, just to mention some of those concerns. And lastly here, just conscious of time, so the guidelines for agents acting on behalf of taxpayers. So Revenue has updated the Tax and Duty Manual, Part 370004B, for agents and or advisors acting on behalf of taxpayers. So the amendments include registering as an IOSS intermediary, contact details for the National TAN Register, guidance for agents, registering LPT clients and IOSS clients, the apportionment of specialist advisors for one-off transactions, and electronic signatures. So as I say, just to mention that those new guidelines are up there, so do take a look at them. And again, just to reiterate, if you have anything, if after this, when you're giving your feedback, when you get to that question or in the single I suppose most pertinent issue you may be encountering as a tax advisor and or accountant acting on behalf of your clients, do let us know, because this will all help our work plan over the next few months. So that's try to keep that as much in time as I could. So that's your ROI tax update for today.
Caro, thank you very, very much. That was very comprehensive. Really appreciate that. And one of the questions that came in, there was a topic you hadn't touched on, but it was about BIK and PRSAs, the changes that happened there. Now, I know that Damien Cooper, our sponsor from Accuvest, wants to talk about that. So perhaps, Gerard, if you're still on at that point, you might you might just maybe give your view there on the query that's come in as an observation that it's quite generous. So I think that people need to be aware of it first of all in the first instance. And if you yeah, absolutely. So we'd appreciate that. Now, thank you very much, Gerald. So now we're now going to move on to Mike O'Halloran, technical manager from the professional accountancy team. Mike, you're very welcome. Now, I have to preface our whole thing by saying we're running a little bit behind time, Mike, but this is very important. So we'd better give it a bit of it's due attention. What's happening next? Fred 82, Mike, tell us all about it.
Yeah, thanks very much for that, Conal, and thanks for having me on. Yeah, so I suppose the purpose of my slot is just really to give a summary of the proposed upcoming changes to UK and Irish accounting standards, and specifically FRS 102 and 105. I think you mentioned at the start, Conal, it's a core standard, and it certainly is, and certainly in terms of FRS 102, it covers a lot of ground in terms of the type of company and the size of company that applies it. So it's a very important period of time whereby these proposed changes are out for public consultation. So I'm just going to take you through where we're at on that. So in December of last year, the FRC issued Fred 82. So just up on the screen, I have a couple of questions just really to set out the background of I suppose why we're at where we're at, and what the FRC are, the process that they're going through at the moment. So So what is FRED 82? So any FRED stands for Financial Reporting Exposure Draft. So the Financial Reporting Council issue FREDs whenever they're proposing to make changes to the accounting standards, and it's the FRC's established policy to carry out a periodic review of the standard at least once every 5 years. So what is a periodic review? It's a scheduled review by the standard setter after a period of time, and that allows the FRC just to do things like, consider changes and improvements that can be made, to consider stakeholder feedback, and just to take stock of where the standards are at. And as I've said, we typically expect these to happen every 4 to 5 years. So the last periodic review of FRS 102 resulted in updates which commenced on the 1st of January 2019. So that there was quite a few changes back then, which I'm not going to go into today, but I suppose it was the first such review of the standard. So I guess there was quite a bit of change expected by virtue of being first review. So I suppose why do the FRC periodically review the standards? And I guess it's a valid question. Why do we spend time learning how to apply standards only to have to learn new practices and rules every so often? And I guess the answer to that question is really a number of reasons. First of all, a periodic review allows both the FRC and stakeholders to speak to each other and to consider what improvements are required to the standards. Is there anything not working? Are there any unintended consequences of certain provisions within the standards? So it just allows that discussion to happen. Another reason why the FRC periodically review the standards, the FRS standards are IFRS based, and therefore any change at IFRS level then prompts the question as to whether, well, should this change also be made to local standards, but with necessary simplifications, obviously, because the entities applying these standards don't require complex accounting standards. And another reason is that from time to time, there are new and emerging issues that weren't previously envisaged the last time the standard was updated. So that's why the FRC go through this periodic review process. So what factors do the FRC take into account when they amend the standards? Well, they take a lot of factors into account, but generally they look at 3 broad pillars when they're identifying what needs to change in the standards. The first area is, have there been any, are there any improvements required? So have stakeholders told us of anything that's not working or that's unnecessary within the standards? And we'll see in a couple of minutes. Back in 2021, the FRC issued a request for views, which facilitated that discussion on improvements required. Another area that they look at are changes at international standards. So as I've already said, when changes happen at an international accounting standard level, the FRC consider what changes should be incorporated into UK and Irish accounting standards in a proportionate and cost-effective manner. And in recent times, we've had 3 significant changes to international standards in the form of IFRS 16 leasing, IFRS 15 revenue, and IFRS 9 financial instruments. So this periodic review proposes changes that brings in the leasing and revenue requirements of IFRS 16 and IFRS 15 and applies them then to Irish and UK accounting standards. In relation to the third of those changes, IFRS 9 financial instruments and also the expected credit loss model within that standard, the FRC that they've decided at the moment that it's not a good time to incorporate these into FRS 102, but they've indicated that they may do this at some point in the future. And the third area that they look at is wider developments in corporate reporting. So what's the planned timeline for the review? And that probably gives me a useful segue into my next slide. So the last, what we have up on the screen here is the periodic review timeline from the end of the last periodic review to the end of, or the planned end of the current periodic review. So the last periodic review of FRS 102 resulted in changes that became effective on the 1st of January 2019. And in 2021, the FRC kicked off the initial phase of this periodic review when they issued an invite to stakeholders to submit their views on the review. So we in the Institute, in our Financial Reporting Technical Committee, we issued a response to this request in late 2021 that hopefully if anybody who has the slides should be able to use that hyperlink if they want to view a copy of that. But some of the key points that we would have highlighted back then were the need to road test new requirements that may be proposed before widespread adoption. So if the FRC were going down the route of bringing in leasing requirements, bringing in revenue requirements or expected credit loss model requirements for financial instrument impairment, that there would be a sufficient road test of those requirements before they're adopted. We also highlighted the need for including necessary simplifications for some smaller companies. As I've said already, that that there's a wide range of entities that use FRS 102, and we just highlighted the need for necessary simplifications for some smaller companies. We also highlighted the fact that the UK is no longer bound by the EU Accounting Directive, and therefore, if there was any changes to the standard that were contrary to the EU Accounting Directive, that Irish entities would need to be scoped out of those amendments where necessary. And we also highlighted the potential implications of companies having to bring leases onto the balance sheet, which could then impact on their company size, which obviously has other knock-on implications. So currently, FRED 82 is out for consultation until the 30th of April. And after that, then the FRC will spend some time considering the feedback and issuing some final amendments. And we'd expect those final amendments to be published in or around January 2024, on the basis that the effective date will be the 1st of January 2025. So that's kind of a rough idea of the timeline. And if we move on to the next slide, we'll just look at some of the key changes that are being proposed as part of this periodic review. And certainly for the moment, I guess it's just important for accountants to be aware of the proposed changes to the standard. And certainly in the area of leases, there are significant changes which could impact on how assets and liabilities are measured and recognised. So I suppose just to look at, I guess, how we currently account for leases as a lessee in FRS 102. So currently, our starting point is an assessment of whether a lease is a finance lease or an operating lease, and then the measurement and recognition requirements will generally flow from this. So if something is classed as a finance lease, we go down the route of capitalizing it, and if it's an operating lease, then we go down the route of expensing it. So FRED 82 proposes a leasing model similar to that of IFRS 16, with a right of use asset within your fixed asset section, recognised instead of operating leases being expensed. And that will require that all leases are recognised in fixed assets and capitalised, regardless of whether they're operating leases or financing leases. And similarly, the level of indebtedness to the operating lease would also be brought in the form of a liability. And obviously, the asset that's capitalised in the case of an operating lease would be depreciated over the life of that lease. So why is this change being proposed? The FRC noted that based on their feedback, that if it was appropriately simplified, the on-balance sheet method of lease accounting would provide more relevant lease accounting. It would also improve the comparability across entities, and it also gives a clearer assessment of the company's position and level of indebtedness. So that's why the FRC are proposing this change to FRS 102. I suppose one way of looking at it is IFRS 16, but with simplifications, and some of the simplifications that are being proposed are up on the screen. So IFRS 16 requires an entity to apply the company's incremental borrowing rate if there's no rate implicit in the lease, and sometimes that can be a difficult thing to determine. However, FRS 102 allows a company to use their obtainable borrowing rate or a publicly available gilt rate, and that should be easier to determine for the purpose of present valuing the future lease payments. There's simpler accounting proposed for lease modifications, so a reduction in the number of situations where a lease modification requires a revised discount rate. There's two provisions that are already in IFRS 16 but are being carried in the proposed changes to FRS 102. So that's the short-term lease exemption. So leases with a term of 12 months at commencement date are exempt from the requirements. And there's also a low-value lease exemption. So if a lease meets the definition of a low-value lease, then it can be exempt, and there's guidance and examples to help users to determine, well, what's a low value lease. So some of the examples the FRC have given in relation to what's a low value lease are things like computers, home printers, phones, portable power tools, those type of things. And then on the flip side, items that are generally not considered to be low value would be things like cars, trucks, land, buildings, etc. So there's a simpler approach also for recognizing gains and losses on sale and leaseback compared to IFRS 16, and there's also some transition simplifications proposed. So the modified retrospective method, whereby there's no restatement of comparatives upon adoption of the rules. There's also an option there for an FRS 102 company to effectively apply IFRS 15 or IFRS 16 if they so wish. And the reason that's there is if you have an FRS 102 company that's part of an international group that reports up to an IFRS parent, they can effectively apply the IFRS 16 rules. so they don't have to do a complicated consolidation exercise when they consolidate up to their international parent. I suppose what about FRS 105? And I guess it's good news if no news is good news that there's no changes from the current methods within FRS 105. The FRC noted that they considered bringing this into FRS 105, but the costs of implementation were deemed to outweigh the benefits of it. So that's so from an FRS 105 point of view, there's no changes. And just on the next slide, then we have revenue. So I guess after leases, the next significant change proposed is in the area of revenue. So the FRC are proposing an entirely rewritten section 23, which is effectively a simplified version of IFRS 15, and that's been effective at an international level for a number of years now. So currently FRS 102 is based on the rules of IAS 11 construction contracts and IAS 18 revenue. And these changes are proposing a more comprehensive framework and an improved structure for revenue recognition that should improve consistency of reporting and comparability between entities. I suppose it's important to note that many entities mightn't significantly change how they report revenue as a result of this change, but some entities will have to consider the nature of their sales and how when they recognize revenue. So if you have maybe contracts with multiple performance obligations with them, you might have to consider, well, how and when do we fulfill these performance obligations? I'm not going to go into the 5 steps of revenue recognition in detail, but just to give you an idea of the proposed architecture, there's a 5-stage model for revenue recognition. So you identify the contracts with the customer, identify the promises in the contract, you determine the transaction price, you allocate the transaction price to the promises in the contract, and you recognize revenue as the entity satisfies the promise. I guess for a lot of sales, that'll be quite a straightforward exercise, but those steps are there, I suppose, to facilitate where revenue recognition might be a bit more complex in an entity. What about FRS 105? So there's similar changes being proposed in FRS 105, and that's just to ensure there's consistency of revenue reporting across the 2 frameworks. And just if we look at a few of the other changes that are being proposed, so for UK entities, the encouraged disclosures in Appendix E are now moved to the mandatory Appendix C. So just I guess to give a bit of background to this change. So currently in the Republic of Ireland and the UK, companies must prepare their financial statements in accordance with their local laws. So these requirements are set out in Appendices C for the UK companies and Appendix D for Republic of Ireland companies of Section 1 of FRS 102. And these are the legally required disclosures. However, up to now, the law can't require an entity to make further disclosures. And previously, these disclosures were included in Appendix E, which were encouraged disclosures and required judgment. So they were encouraged by the FRC in order to give a true and fair view. So because the UK is now no longer bound by the EU accounting directive, the FRC can require further disclosures above that set out in UK law. So as a result, the disclosures in Appendix E are being promoted to Appendix C just for UK companies only. So there's no change in the Republic of Ireland as a result. This is just purely for UK entities. Section 2, which deals with concepts and pervasive principles, that's been rewritten based on the IASB conceptual framework, and that's just to ensure consistency with its IFRS counterpart. There's enhanced going concern disclosure requirements proposed. So when accounts are prepared on a going concern basis, the entities must disclose that along with confirmation that it's considered future-looking information as part of that assessment. There's also disclosure required about significant judgments made in assessing an entity's ability to continue as a going concern. And the FRC are proposing the removal of the option to newly adopt IAS 39 for financial instruments, and that's in preparation for the eventual removal of this option when it's no longer required. There's clarification of costs which are included when determining if a lease is onerous, and that change is proposed by way of an amendment to the appendix to section 21 of FRS 102. And there's also guidance on how to identify the acquirer in a business combination. I suppose one of the key points that the FRC decided not to press ahead with is the expected credit loss model, which is part of the IFRS 9. They considered bringing that in for certain asset types in FRS 102, but they decided not to. They decided to maybe wait and see until a similar change is being made at the IFRS for SME level, and they're waiting to see how that goes before they consider that at a future date. So that's some of the key changes being proposed. Obviously, that's not a complete list of all the changes, rather an overview of some of the key changes. And just on the next slide, we're just going to look at how members can get involved. And I guess the first thing that you can do is understand the changes being proposed. Obviously, we're not going to see these changes in reality until, you know, it's likely going to be years commencing on or after the 1st of January 2025. So it'll be, you know, 2026, possibly by the time we see these make their way into financial statements. But it's just important to understand the changes being proposed, and hopefully this session will give you a bit of an introduction into those proposed changes that you can familiarize yourself with over the consultation period. We're delighted to have the FRC coming over to us to Dublin on the 29th of March, and we're going to have a free event for members to attend. So hopefully as many members can attend as possible. It should be a good event. The FRC will give us, I suppose, their insight into the proposed changes, and there'll also be space for some Q&As at the end, so it should be a very useful event. And we're also hoping to have on the same day after that event to have some roundtables that members can participate in, and that'll allow, I guess, a more in-depth look at the changes if members want to give their views on that. So that should be a very good event. So please keep it in the diary if you're able to attend. As I said, the FRC are very keen to engage with our members and hear their views on the proposed changes, and also to hear views from a wide range of stakeholders. You know, they're very aware that FRS 102 particularly covers a lot of bases. So I mean, the more stakeholder feedback they get, the better. And so we hope to see you there, and we'll be putting out details of that event shortly. Just once we finalise the timings, we'll be sending the details of that event out. I suppose the next thing that it's important is just to consider how the changes will apply to your clients. So there's some clients who won't be impacted very much by the changes, but there'll also be some who will have big changes, and the ones that you'd be thinking about here are maybe clients who hold a lot of assets by way of operating leases. There could be a fairly substantial increase in their assets and in their liabilities as a result. So I guess it's important to be aware of the changes, just so you'll be able to inform your clients as to what changes are potentially coming down the track. You could also consider making a response to the FRC. We have our own process for responding to these consultations in the Institute, and we'll be doing so via our Financial Reporting Technical Committee. Members are also free to make their own submissions to the FRC if they so wish, and we'll also be engaging with members during the consultation period also. And details of how you can make a response are included in the invitation to comment section of the FRED. So as I've said, the FRC are keen to hear as many views as possible. And the closing date is the 30th of April. So hopefully you'll be hearing from us during that consultation period in the form of events or engagement on the matter. So hopefully that's been beneficial. I'll hand back to you there, Conal.
Yeah, absolutely, Mike. That's very, very interesting. If I was to just pick out one point which jumps out at me, is that is what you were saying about having assets on operating leases, including buildings on long leases. So they're going to be brought onto the balance sheet. So I think it's important that people are aware that this could result in larger balance sheets, which has a lot of different knock-on effects around audit exemption, size of companies, and CSRD, which is going to be the next thing, because that obviously applies to large companies. So now I'm going to hand over to Jeremy, who's going to host a discussion about sustainability and CSRD with Dee and Susan. So it's over to you, Jeremy.
Indeed, Conal, thank you very, very much. And yeah, the FRS 102 updates, it's great actually that you as members have an opportunity, as Mike said in the meeting there on the 29th of March, but also to actually give your input into these changes that will impact so many of your clients as well going forward. Yeah, listen, I'm delighted to actually welcome back. I'm sure regular viewers of Practice News will be familiar with both Dee and with Susan. And Conal, I think if you can click to the next slide there, we have a lovely picture of Dee and Susan as well. For those of you who don't know, Dee is our actual professional accountancy leader and works in our advocacy and voice team, as does Susan. And Susan is our sustainability officer. And today, sustainability is an area that I'm sure you're familiar with, that is growing in coverage in the media. and its impact on companies large and small. And also you can see in the Institute here, we are pushing out more materials, more guidance and so on, and trying to assist our members as they try to implement measures in their own companies. So we said we'd actually have this actual segment here today to update you on some of the key changes, particularly things like CSRD and so on, with relation to sustainability, but also to update you with relation to the actual guidance that we have available. And before we kick off, and Dee is going to tell us about CSRD, Susan, it's great to have you back. And I know, Susan, you were with us a year ago exactly, and we had an initial, I suppose, build up your knowledge session on CSRD and so on. And I think you're in a great position now. Things have moved on a lot in the last year or so. And I know you have a slide. It's actually in the next slides with resources there. But even off the top of your head, if you can tell us a couple of the key issues just to set the actual thing that have changed, if you were to say 4 or 5 issues that have changed on the CSRD front or move forward, and we'll set the scene for us.
Certainly, and it's lovely to be back, Jeremy. Thank you very much. A lot has happened in the year that's been in it. And I have a slide for several kind of high-level macro trends. And I'm not seeing the slide on the screen there, but that's
if you
not a
can click
problem
ahead
because...
about 5 or 6 slides just through actually Dee's material there. And
okay, and apologies for that. We're actually, there's spoiler alerts here. We're close your eyes, everyone.
And
look at these. Yeah, so here we are. So as I mentioned, sustainability. Dee is going to look after sustainability reporting, particularly the CSRD, which is such a high-level news item and is part of the overall trend of the attempts to make all of the different, the multitude of frameworks and standards comparable. What I've noticed with sustainability generally is that the role of business in society, even in the year that we've just seen, has accelerated in the sense that there's almost no place to hide. And the businesses appear to be responsible almost for everything. And there's no, I've put it there that there's no major environmental, social or geopolitical issue off the table. And what I mean by that is under the ESG brackets, that this is how we describe sustainability under ESG, environment, social and governance. So under, say, the environment pillar, and particularly in climate, this year has shown an awful lot of extra scrutiny on businesses of all sizes. And particularly, obviously, the fossil fuel industry is something that we have seen only in the last week or so. And the combination of various international factors like the illegal invasion of Ukraine and then the energy crisis that we've seen, there's been increased scrutiny on, say, the enormous profits that the fossil fuel industry companies have been generating. And then combined with the losses that businesses made, long-term, long-established businesses going out of business because they can't afford the energy prices rather. So there's an awful lot, and then the scrutiny as well on, say, the pledges that the companies are making versus the actions that they're taking, how much they're investing. And so actually, really interestingly, IASA, in its most recent kind of compendium of financial decisions, made a point of asking kind of challenging and robust questions of certain statements that would be made, climate-related statements that some of the companies were making. And that, considering that they would traditionally have focused on accounting standards, this was quite an interesting development, that this was a new area of focus, and it speaks to the change and the greater scrutiny that is taking place now in companies with these particular pledges. Under the social, I mentioned the in Ukraine and the invasion there. A lot of scrutiny was put onto companies with how they reacted to that particular invasion, particularly how quickly they ceased trading in Russia. So a high-profile example would have been McDonald's, which did pull out of Russia and left 7% of its revenue on the table there. So that was a really interesting development as well, but the social impact that had. And funnily enough, transparency, I know Dee's going to speak more about greenwashing, but transparency is so important now that there's been developments like a Yale professor actually has set up a tracker kind of rating particular companies A to F, and A being how quickly they remove themselves from Russia, and F being the companies that stayed there to dig in. So it's been quite a year for that. And as I said, nothing is off the table. Under the governance, then we've seen a lot of developments in both the large geopolitical ones. We've seen the IRA, the Inflation Reduction Act in the US. And the ripple effect that's had in Europe, where Europe is now reacting rather nervously to that, because the IRA is putting $360+ billion of investment in clean tech and also in EVs. So Europe is feeling the threat of that, and it's introducing its own, for long held, but certainly it's accelerating some of its own tools and policies, the most famous being the carbon border adjustment mechanism, which will have an impact then on businesses large and small, because that is going to be starting to bite now in October 2023. And for those who don't know, the carbon border adjustment mechanism puts extra tariffs on goods coming in to Europe that don't fit the climate responsible production methods that Europe is imposing on manufacturers. So there's a huge amount going on at global level. And while another point, not to put words in your mouth, but I know that you will be making the point that there's no business that's too small not to be affected by these, and also not to be affected by the consumer preferences that are growing for more kind of ecologically positive goods, and for companies to be demonstrating all of the time this kind of commitment to the things that people are seeing on the international stage, like the COP, I mentioned COP27, which was a climate summit, internationally climate summit, and then COP15 is the biodiversity summit, and that's another word I think businesses are going to hear an awful lot more about: biodiversity, how it impacts on your business. And certainly the last thing I'll say is, when I first came to biodiversity, I was like, what has this got to do with business? And I just think of insects when I think biodiversity, but actually when you drill into it, you realize, no, this businesses have an enormous impact on it, and it has an enormous impact on businesses. So I'll be producing more guides on that for companies in the coming year. But I appreciate it. I've taken a lot of time, and I think it'd be very interesting to hear what Dee has to say about CSRD. So I presume you want to move on there.
Susan, thank you there for that actual great overview. It's not easy to set the scene in one slide for where sustainability has gone in the last year or so, but you've done a great thing, and we're going to be back to you shortly again after Dee's update on CSRD, on the guidance and the help you have available. But like myself, I'm sure a lot of the attendees here today, they're learning. They might be coming from a low base of knowledge, but there's a lot of great guidance there. So Susan, we'll be back to you shortly. Dee, your time is up. I know you have been working on the CSRD, just launched, and also the consultation, and you will be seeking some assistance as well, I think, from our members to respond to the consultation. So the floor is yours.
Absolutely. That's great. Thank you, Jeremy and Susan. Good morning, everybody. So this is really a whistle stop tour on the CSRD, or the Corporate Sustainability Reporting Directive. Just to give a tiny bit of context and background. So in terms of, I guess, globally, there's been lots happening on reporting, and sustainability, I think, has just taken on a life of its own. And I guess reporting has been trying to keep up with that. So if we focus on Europe, they brought in the Non-Financial Reporting Directive in 2014, which was brought into Irish law in 2017. Now, that is only applicable to large companies which are greater than 500 employees, and certain other entities, and that would include the public limited companies. And you will see there what the statement had to include in that, and that had to be published in the director's report or as a standalone statement. Europe also saw the European Green Deal, and this was approved in 2020, and that's basically a set of policy initiatives by the European Commission to make Europe climate neutral by 2050. And part of the plan on that is to review each of the existing laws on its climate merit, and also introduce new legislation on the circular economy, on building renovation, on biodiversity, and on farming and innovation. So next slide, please, Connell. So that's just an intro into the CSRD. I think there was very much a feeling that actually globally that everybody was looking for a global set of standards so that reporting was comparable and consistent, because there are quite a number of voluntary frameworks out there. Europe really wanted to provide companies to provide further information on their ESG and to bring more companies into the net. And actually, I think they thought that it would take a long time for global reporting to get up and running. And, you know, they also felt that more assurance was needed, and therefore, you know, there would be less likelihood of greenwashing, which has been explained by Susan. So all of this, I think, led to the impetus for the CSRD. And in fairness, this has really been championed by our own Commissioner, Mairead McGuinness. So what's in the CSRD? So very briefly, if we just start at the top left, so it is it's going to apply to about 50,000 companies in Europe versus the NFRD, which was about 11,000. It has been approved by the EU Council and the Commission, and it that was all done just before Christmas, actually. The scope of reporting, it's more forward-looking. It will be done under the EU taxonomy regulation, and again, the information has to be very clearly identified within either the management report or the director's report as a separate section. The CSRD introduces the concept of double materiality, and this is where it requires an entity to report on sustainability risk from two perspectives. One, how sustainability factors affect the company, so the financial materiality, and the company's impact on society and the environment, which is the society and environmental risk. And this is quite different, I think, and certainly will require a lot of learning on everybody's part. And, you know, I think certainly we have been asking for a lot of examples on this. Reporting format is going to be on XHTML, so electronic format, where everything can be tagged on it. Again, that's probably going to bring its own challenges, but, you know, hopefully software companies and that will have caught up with the issues that there are on ESEF at the moment. It's applicable to companies with two of those three following criteria, so 250 employees, 40 million turnover, and 250 million in total assets. I would say that's probably not that big, and we'll have a chat about that later on. Assurance will be mandatory for the first time. It will be mandatory, and it will be limited assurance until 2028, when we think reasonable assurance will be required. There will be requirements for additional training and education to qualify to carry out a sustainability assurance. The Institute are looking at this at the moment. We're obviously looking at the CSRD consultation that the Department of Enterprise, Trade and Employment have, but I think the way we see it is that separate registration will be required if you want to be if you want to give sustainability assurance, and you will hear more from the Institute about that in due course. And there is also a provision that the sustainability auditor or the sustainability assurer does not have to be the same person as the financial auditor. So I think that's it. Oh yeah, in terms then, the kind of standards around this are the European Sustainability Reporting Standards. There are 13 of those in total. If you can go to the next slide, Connell, please. I will just go through those very briefly. So there's two cross-cutting standards. So there's they're the kind of two overarching ones that apply to everything, and then you have your 5 environmental, your 4 social, your 2 in governance, and then there's a number of what I think are very useful appendices actually in terms of using the standards, comparing them to other matters, and on top of this, there are a second set coming, which are for sector specific. So I understand the first ones will be on, not surprisingly, I guess, oil, mining, the motor industry, the utility industry. So that set are due to come out for consultation in April. The ESRSs themselves are going through the approval channels in Europe at the moment through the Council, Commission, etc. So we are expecting that they will be approved very shortly. So next slide there, please. Sorry, I would just say on the ESRSs, there is a huge amount on them, and there are some fairly good summaries. The eFrag website has them all on it. So if you were looking for a little bit of weekend reading or a lot of weekend reading, some of the summaries on that are certainly worth looking at. In terms of timelines then, so 1 Jan 24, not that long, not that far away, just for those companies which were already subject to the NFRD. And from 25 for other large companies, following on 26 with the listed SMEs, and then you're getting into the non-EU companies and that from 1 Jan 2028. I understand that for SMEs then there will be a version of these which will be, at least in the first instance, they will be they will be there for SMEs, but they will not be mandatory. So I guess you're probably looking at this and going, what does this really have to do with me? It's for large companies. I suppose a few things I would say to you. Large company is not that large. And particularly you heard Mike earlier talk about the fact that the FRS 102 is talking about bringing leases onto the balance sheet. So, you know, that certainly could be a game changer for some of the companies. Also, there is a requirement for companies under the CSRD to report on their supply chain. So, you know, I can certainly see that if you have a client who gets a request for information on issues where they are supplying a large company, I think, you know, they may just come to you and ask you, you know, how do I do this? What's involved in it, etc., etc. So I think certainly it is well worth your while looking at it and keeping up with it. In terms of consolidated sustainability reporting requirements, these are actually different and they may apply even if your client is exempt from producing consolidated financial statements. So, for example, if you were an Irish holding company of a US company which had a number of EU and non-EU subs, you may not have to prepare consolidated financial statements, but under the CSRD, you may have to prepare consolidated sustainability statements. So these are complex and the rules will need to be reviewed, but definitely something to keep in mind on it. Also, I think that, you know, companies are more and more want to adapt elements of the CSRD because they see it as being the right thing to do. And also, I think you need to look at it as being a potential new service line for your practice if it is something that you are interested in. As I say, there will be a separate registration process, but you know, that could be certainly a very good new service line. So lastly, I think you know, what I would say is just to get familiar with the CSRDs and the ESRSs, particularly on the CSRD. There's a lot of really good information out there. The accounting firms and law firms have some really good summaries. The Enterprise Rate and Employment have a consultation out at the moment, due date 9th of March, and that's really looking at the transposition into Irish law. There is a lot of it that will have to be transposed, but there are some elements that we can look at. So I think that's certainly worth looking at. If you would like to send us in anything to include in the Institute consultation, we're obviously very happy to hear from you. As I said, there will be public consultation on the second set of ESRSs, probably in April. Apart from that, I would say ignore it. I would try and get up to speed on it. Visit the technical hub on the Institute website for updates, and we will certainly keep you updated as things progress.
Dee, thank you, Dee, for that very comprehensive update. It's a very detailed area is CSRD, and it's an area I know, as I say, different financial standards and reporting coming along and so on. And it's great as well for the members to actually get that input into these and how it could impact on the audit side or on different things as well. So it's a starting point really for us, and it will evolve going forward. So thanks for that. And yeah, you're right, potentially as well, it will impact for yes, the large companies, which isn't so large anymore as we look at things, but even down the line for the larger and so on too. So it's that's one thing to bear in mind for any size of practitioner and their actual clients. Well, listen, coming back, and I know, Susan, we're bringing you back in here now at this stage. And Susan, I know that we have your guidance there as well. You were very good to give us the quick overview at the very, very start. And you have loads of other guidance as well that even apply for small practitioners and for everybody really, be they in business and practice. So listen, I'll hand back the floor to you to give us a quick summary of how the Institute can help and guide you as you build up your knowledge in this area.
Thank you very much, Jeremy. We have some resources that are specifically aimed for small businesses and practitioners servicing the needs for small businesses. But we also have a certificate in sustainability risk reporting. I can, Jeremy, I think you mightn't be on mute in case there was a, I think your microphone might still be on. You sorted? Okay, thanks. I'm glad to know it's not just me who does that. We have issued a certificate in sustainability risk, strategy, risk and reporting. And this is a new development for our CPD and lifelong learning department. And it's been phenomenally successful. It's now just this morning has announced it's closed the 3rd iteration of the course. And so it's run twice, and it's going to start running again in February, but that particular one is now full. So I imagine they will be having a new version of that course, or sorry, a new iteration of that course coming out again. It's an 8-week course and it's particularly good, particularly useful. What's interesting about it is another aspect that I see as a trend for 2023 and beyond is collaboration. And Dee was mentioning how you've different aspects of a business coming together to report on the CSRD, and you've got people who are providing, businesses are who are not traditionally having to put in and to put out financial disclosures, now being asked to put sustainability information together and reports together. So you will see an awful lot more collaboration between different parts of businesses and also between various businesses themselves. And when Dee mentioned that there's no businesses that's almost too small to be part of this, we as a business, Chartered Accountants Ireland, would be a small to medium enterprise. And I've already been contacted by companies with whom we do business who are larger suppliers. And because we are in their value chain and their supply chain, they're coming looking for information from me about our own carbon emissions and our profile. So it's worth bearing in mind that a large company is not necessarily, even though you might not be a large company, that doesn't mean you're not going to be kind of part of the net of this. So I'd recommend that people check out the various resources that are available. I'm learning more about how to manage your sustainability profile as a business, because it is useful when you get asked questions like this. But when I mentioned collaboration, that particular certificate is being run and being delivered by each of the Big Four. So each of the Big Four is taking one of the modules in that spirit of collaboration, because this is such a vast issue. We also, as part of that, run several workshops, and we've already had 3. One was on Carbon Emissions 101, one was Sustainable Finance, and one was actually on Sustainability Reporting. That was before Christmas, and we've got some coming up now on the impact of the Climate Action Plan and on supply chain and procurement. And I think also maybe there'll be another reporting one again, but it's worthwhile checking in also to see what the CPD team is offering in that respect. We're also including it in blitzes, so people in district societies, when they have a blitz of CPD once or twice a year, one of the subject areas is now always on sustainability. So it's being covered at various aspects. We've produced publications on it. I mentioned the sustainability for small business, but also in collaborating with other global organizations like Accounting for Sustainability, and Dee sits on the task force of the Accounting for Sustainability, looking after sustainability reporting, that produced a very good a new edition of a very good publication called Navigating the Reporting Landscapes. There's plenty there, and I've got a sustainability hub on the website, and all of these are accessible on it, and they link out to various other parts of the Institute, like the technical hub, where all of this information is accessible. There's also new modules on that hub, and the goal is to keep it as accessible as possible. So I just have maybe one page in some of those modules on the circular economy, on modern slavery, and on biodiversity, and all aspects of ES and G that companies may have to be aware of. And also it's worthwhile checking out Chartered Accountants Worldwide. I look after I chair a task force there on sustainability, and last year we published a roadmap for chartered accountants. So it's a sustainability roadmap to show how an accountant may interface with sustainability and the journey that they will take, all from beginning and building your knowledge all the way to sustainability reporting. And we've conferences on it, Ask the Experts, short interviews. We take part in various initiatives like Climate Finance Week, and we also have a lot of content that's producing every week, like the technical roundup from Dee's team, my own sustainability bulletin, and Carol was talking about TBES and various other aspects that are also included in things like the tax update, governance conference, chapters. There's a huge amount going on. So I'd urge everyone who's interested in this, go onto the sustainability hub of the website. You'll find routes out to all the other aspects of the Institute that look after this. And it's all free, all downloadable, and all accessible. And finally, in the spirit of collaboration, I'm also set up a sustainability network. A network for practitioners who are currently working in the area of ESG, or who are working on projects related to ESG. So they might be working in large organizations, but having to look after ESG reporting, or being tasked with carrying out a project for maybe carbon emissions accounting. So that there's information on that in the sustainability bulletins, but also on the hub. So it's all there. It's all there for you. So Jeremy, well, I can see you're back.
I think I'm back, and I'm back at the right time now. So my apologies for cutting in earlier, and I don't think I was saying anything too offensive. Listen, you've given a great actual update there. I know there is a wealth of guidance material, and you're right. I always find it so many stories that you've gathered together, and on the e-news on a Friday, the Sustainability Bulletin, and I know social media are very active. And I think that's a great idea too, the network group, which is, I know, in its formative stages. I think you're both online and meeting in person. And for anybody who has an interest in this, or even wants to learn a little bit more, you don't have to be an expert. I'm sure there's a place for people like that as well, as I say to you. Listen, it's been great to have you, Susan, back on a year on, and to show the extra guidance and so on. And Dee, it's been great as well for with CSRD. And I know you're going to be asking the members, Dee, and I think you mentioned that to put their input in as well, because that consultation is going to be coming back by, is it early March we have to get back to?
9th of March, yes.
The 9th of March.
Yeah.
So I'm not sure when your timeline is, you may have mentioned it, but I know you'd welcome any input as well, because this is going to, no matter the size of your company or your clients, this is going to impact us all and grow in importance over the years.
Absolutely.
Well, listen, guys and ladies, actually, more accurately, thank you very much for joining with us here today. I know you might stay on for the next session as well. We'll have a panel discussion, or maybe some questions coming in, but it's been great to have that update here. So Susan, Dee, thank you very, very much.
Thank you.
Thank you.
And listen, Cornel, I know you're going to click ahead as well there, and you have the slides there. And I'm actually delighted to be joined here by Maeve Hunt. I'm sure many of you may know Maeve from her former role as the chair of the Ulster Society. I think she's the last name on one of these plaques here just behind me for 20 and 2021. And Maeve also now, since last year, is also on council and is our chair of our Members in Practice Committee. And listen, Maeve, that's a little bit of an introduction about yourself. I know as well, Maeve, you've also spent the majority of your career in small and mid-sized practice. Tell us a little bit more about yourself first before we get on and talk about the nitty-gritty of the Members in Practice Committee.
Well, thank you, Jeremy. And firstly, thank you for inviting me on. So I'm very delighted to be here. So as you said, I trained in a small, medium-sized practice and actually was there for a total of 11 years. I'm going to make myself sound very old there, but I was there 11 years. I had a brief stint of a year in business, but actually realised practice was for me. So went back and was a manager there for a number of years before I ended up in my current role as Director of Audit Insurance in Grant Thornton in Belfast here. So for the last 5 years. So Yeah, it's been all practice based, as you said, but actually, as you said, the majority of it has been in small to medium sized practice. Also, as you mentioned as well, very strong connection with the institute. Actually from student level, I'm probably on the board for the student society there as well. So we're back in the day, and as you mentioned, I had the honour of being Ulster Society chair there for the last 2 years, previous to Emma Murray. So I've been always heavily involved in the institute and actually realised the breadth of services that it gives. So I've always wanted to get involved, and therefore I decided I wouldn't stop there and I would go on to council. So decided I would go for council last June, and thankfully got voted on there in June. So it's been great.
Congratulations.
Thank you
and
so
with
much.
Council, I know an opportunity has come up as well to join us as the chair of the Members in Practice Committee.
Yes,
And
absolutely.
so congratulations on both points. And I know you've been the last few months, probably since the autumn of 22. So this has been a great opportunity to introduce you to the wider audience. You're very well known, I'm sure, in Ulster and maybe from Council, as I say to you, but also across the island and so on here today. And listen, I know it's been a little bit probably of learning exercise, and you would have been involved in the practice side as well through your long involvement with the Institute over the years. But tell us a little bit more. Many of our audience here today will be familiar with Members in Practice Committee, and it after all is the committee for actually practitioners, for small and mid-sized practitioners. It's your committee in the Institute, your voice and representing your interests with regulators and so on as well. Tell us a little bit more about the committee and what it does for SMPs.
Yeah, so as you mentioned already, it represents the interests of those general practitioners, mainly small to medium-sized practice. And what struck me whenever I joined it was the breadth of services that the practice consulting team, fantastic practice consulting team do, and how they link in with them, you know. So it was really a forum for any challenges or opportunities that have come up over the years that they can feed back to the practice consulting team, and then, you know, whether it be CRO, company's house, revenue, always quite a lot. And just that information given, you know, was really, really important. And the back and forth. And then, as you mentioned, it's across the island of Ireland. There's a representation as well. So small to medium-sized practice in all breadth of types of services, being tax or insolvency or audit, you know. So yeah, it's been really interesting, and I've really enjoyed it so far.
Well, I'm glad to hear you enjoyed it so far. And I actually know on that slide there, if you have the PDF of it, Maeve is one of about 15 members or so. We always have the odd one coming and going inside that committee from right across the island of Ireland, my own home county in Kerry to Belfast and right across north and south. And if you want to learn more about who is actually on the Members in Practice Committee, you can click that link there. You got the names, the towns, the practices they actually serve. And the whole idea for the Members in Practice Committee is for the members to be actually that link down into the actual community itself of practitioners to feed up issues that they can bring to committee level for follow-up then by our advocacy and voice team or ourselves with revenue, HMRC, CRO and so on as well. And for us as well to get your comments and your insights. I know Maeve, you'd welcome, as I say, and I know you can come back to us through our practice members email if you have any comments or different things, and we will, as I say, be running, of course, like practice news and other events as we go through the year as well. So it's there for you, I think, is the real summary.
It is absolutely, and you know, any issues that anyone has, it's fed back, you know, and there's some real tangible evidence that this has been heard, you know. So whether it be a consultation paper to, you know, IASA or FRC or revenue or and any kind of direct links that we have with CRO as well, you know, issues are being heard through this committee and through your team obviously as well.
Indeed. No, it's been great. Particularly, I know, yeah, so recent times of COVID, yes, CRO, revenue, HMRC, and a lot of good work going on there with the actual different teams, be it on the tech side and so on as well. But listen, that's hopefully given you a little bit of a flavour about the Members in Practice Committee. If you want to learn more, you have, of course, can click on that link and actually contact any of the members there if you want to have a chat about an issue that can be brought forward, or if you want to contact our team here in Practice Consulting or indeed Maeve and so on as well. You have that through the practice members' actual email and inbox or directly with Maeve. Listen, that's enough about the committee. Obviously, the committee here is to help you go forward. But a part of our team here as well is to look ahead to 23. And listen, I suppose with your experience and so on as well, if I was to ask you, having worked in, I'm still working in small, mid-sized practice and a range of clients in the SME sector, a very important sector here in Northern Ireland, and I'm sure public sector as well. I asked you, what is the one thing you would say is key for practice this year? It could be a challenge, it could be an opportunity. for 23 that you'd like to highlight? And I'll be asking Damien and so on as well afterwards. But what probably one thing you'd say?
I'll probably give one of each, actually. There's quite a, well, I suppose I could, not to be too negative, I could probably give quite a lot of challenges, but I don't want to go down that route. It's probably been heard several times, but I think the major challenge for practice is still staff shortages and the lack of talent, coming through, and it's, and that ranges from small, medium to large practice. I think it's across the board, and actually indeed in industry also. Real, hard challenge for anyone who's just starting out as well. Then I suppose an opportunity is, I think any kind of practitioner is needed more than ever, and it's been said today, when you're talking about sustainability reporting, whether it be any kind of regulation updates, we are needed as advisors more than ever. So I think that in itself is an opportunity, but obviously with additional support being needed.
Indeed, I know we're always saying it's to specialise, and you're right. We're always looking at practices moving up from more the compliance level to the advisory level, and to identify these opportunities. Right, sustainability in the long term, I think, will take a lot of our members and interests in sustainability reporting. Something we're just beginning to see the start of. But even specialty things, probably hate to say it, there's an opportunity maybe even in insolvency at the moment, because unfortunately we are going to see a growth in that demand for insolvency services, be it things like we're seeing with the SCARP in the Republic of Ireland, but also with the more common insolvency north and south. Listen, Conal, I'm going to broaden out our conversation here now, and I know we have Damien here as well, Damien from AccuVest, and I know, Damien, you would be an expert in your role in investments and economic updates, and I was just last night reading one of your newsletters and so on as well. I know you put them out quite often and so on, and I know you have also as well, you had a very good article I was reading lately, and it was a team in Cornwall touched upon the PRSAs and the opportunities that are there as well. Tell us a little bit more about your thoughts for the wider economy, the SME sector, but also that's PRSAs.
Sure. Yeah. Well, thanks, Jeremy. Nice to meet everybody, and to be here for Practice News again in the new year. Although it's old at this stage, I suppose. But I suppose where we look at looking where we are, you look at where we've come from, and from our client perspective. Excuse me, investment markets, 2022 was one of the worst years on record, particularly for anyone invested in bond investors. Interest rates, inflation, slowing economic outlook really resulted in huge losses across the board for asset classes. Now, thankfully, it was on the back of a few very good positive years for markets, but it's still sitting here now at this stage, the outlook is that the experience is that people are nursing wounds, I suppose. Thankfully, we've seen a good rally in January in markets, but we do look at the big things that are going to impact, I suppose, businesses and investors, from here on is as mentioned there, labor market tightness is a big issue across the world. It's a huge issue in the US, in the UK. I saw statistics recently on the unemployment records. The prints being slightly below long-term full employment levels. So that tightness is coming through in the statistics. The anecdotal tightness that we're hearing from businesses, from clients of ours, is a challenge. What that's potentially leading to, I suppose, as you have inflation having come through over the last year, you've got increased cost base for businesses. So you've got increased energy costs, significantly so over the last year. Thankfully, oil costs oil and gas levels, prices have eased off a little bit. And so you're looking at probably a flattish year from here, but I think last year people had maybe some reserves, or they only had increases for part of the year. So that's likely to have been big increase in profitability for companies. Labor cost, if you can't hire people, although if you're understaffed or under-resourced, potentially in the short term, that's maybe it's not as much of a negative for your bottom line, but really it's a challenge for being able to get the revenue out there, get the business done. And also if you're working that hard to try and get people, what you do tend to see is labor, and wage inflation coming through, which sort of which compounds the issue from from an inflationary perspective and from a business cost perspective. Then obviously from a corporate profitability perspective, from our perspective looking out there, that's a challenge for investment markets, because while there has been this big increase in interest rates, lots of that has been priced into markets, but there is still potentially a big risk to corporate profitability, and that may result in further volatility and further falls in markets. So so that's they're the big things that we see from obviously from a UK and Irish perspective. Any businesses that have cross-border trade, Brexit is still an ongoing issue. Thankfully, we've seen a little bit of positive developments over the last while from that perspective, or on the political side of stuff, but still a long way from being solved, and is a big issue for members, I suppose, with cross-border activities, or north or south of the border. It is a big issue from an Irish perspective. Less so from a global economic perspective, and from a markets perspective, it's less of a big issue. But certainly from a member perspective, from their client perspective, and from an Ireland Inc. perspective, it is. In terms of, you asked me briefly about the pensions legislation, and I think one of the things that we're seeing, and probably is likely to be a big factor that's likely to be important to a lot of clients of members and of practices, is that change in pensions legislation in relation to the tax treatment and the deductibility of contributions for employer contributions into PRSAs, and it's one of the more significant, I suppose, changes that we've seen in quite a while. I saw the questions earlier on come through when Garrod was asking about it, sort of asking, it's a very significant change. Is it a mistake? And who knows is the answer, but all of the analysis that we've heard is that it was a deliberate move, that they were aware of the loophole that's created there. It really does create a big opportunity for business owners to extract value from their business, for themselves or for their family members, by building up big pension pots, potentially up to 2 million per individual that is employed in the business, but obviously only for employees. And really, I would expect businesses, business owners who are obviously clients of many practices around the country, they will want to talk to somebody about it. It is likely to be, it's something that they will need to know about, and it is worth talking to an independent pensions advisor about it, because if someone is suddenly looking to make big contributions into a PRSA that they weren't looking to do in the past, you need to make sure that while you were happy, with the arrangements you had in place for small, ongoing, normal contributions when you were just, making retail contributions, and that was fine. Really, if you're looking at big contributions, your fees are going to make a difference. The flexibility that you're going to have, the degree of control, you need to make sure that you've planned it properly, that you have, that you've planned your strategy right, that you have the right products in place, and that you have your entry strategy appropriately planned, and that you don't just, I suppose, fall in with what I used to do when I was putting 10 or 15,000 or 30,000 in. If you're putting hundreds of thousands potentially into a pension product, it's a different perspective, and it's important that people get good advice and make sure that they're happy, because the last thing people want to do is regret not having to spend the time and effort just to plan something properly.
Absolutely, Damien. I just jump in there. You waited very patiently, Damien. You're our last contributor of the day, and we're running a bit over time. Those are really interesting perspectives, I have to say. First of all, I got your newsletter this morning. I have on a feed now. I thought your 2023 predictions were brave, and 25 predictions for 2023. Very brave.
I think you'll find that there some of the predictions are what we're seeing out there as market expectations. But absolutely, I mean, it's a very uncertain time. There's lots going on. Obviously, you've still got a war in Ukraine. You've got a massive slowdown in economic growth, maybe slightly less severe than maybe was expected in Q4. So a little bit of positivity coming through there. But you still have inflation very high. It looks like it's peaked, which is great. But still sticky, and interest rate rises again, the markets are all looking forward to, oh yeah, maybe they won't, maybe there is an end in sight to that, and they're pricing in when will it stop, and when will they get reversed. But still, you've got a significant amount come through, and markets and businesses and consumers dealing with and adjusting with a massive shift in their cost base over the last year. And so I don't think the world has adjusted fully to that. I don't think the world has adjusted fully to what working from home or hybrid working or what all that sort of stuff means for different industries and different businesses. So there's a lot of uncertainty out there and a lot of adjustments still taking place. Obviously, there's some positivity. We do at least have, as again, slightly better economic figures coming through. I saw the UK did manage to avoid a technical recession with flat to very slightly positive in Q4, which is great. The Eurozone again managed to get very slightly positive figures, again marginal, almost in the rounding difference, of the whether you're positive or negative, but everything that's a positive, everything that's not a negative is a positive, I suppose. And thankfully, you've got China starting to open up again, so there's lots of potential positives, or less gloomy things than we might have looked at this time last year. But I still think we're going to have very volatile year, very uncertain, and therefore in that instance, if you have a bit of certainty about where you're going, where expect the unexpected to a degree, and be ready to take advantage of stuff. I think there will be opportunities, and significantly more so, I think, than last year. Thankfully, I don't expect markets to be anything like as negative as they would have been last year. So I think it's a good time now to be doing a plan and getting yourself prepared and armed in order to take advantage of that. And particularly if you are someone that is looking at business exit and potentially has something like a PRSA now as an additional option available to you.
Absolutely. So look, I mean, you've got a lot of different perspectives there. You've got the Irish economic outlook. You've got the European. You've got the British. So I mean, I don't know, Maeve, in terms of all that. And of course, you got Northern Ireland itself as an entity. I mean, when you compare the UK as a whole, Northern Ireland, ROI, EU, it's so difficult to make a prediction or have to have a view when you're trying to advise clients what to do next. I mean, what sort of things are going through your mind as you're advising clients who think you've made capital investment decisions and so forth?
I think a lot of it is uncertainty, and I think it's a big word, isn't it? Like you mentioned it already, but geopolitical uncertainty, I think there's still probably some shocks to come. I probably will say that probably sounds quite negative, but there probably is. But overall, it's really, things weren't as bad as it was predicted, but it still could be. Is probably what I would say. So absolutely. Yeah, it's very hard to call whenever you're talking to clients, I will say.
Yeah, absolutely. I couldn't agree more. It's just when you're looking at all the different messages, like we see all the tech layoffs in the United States. How's that going to affect also this side of the Atlantic? But then you got the contradictory news about pretty strong job growth in the US. So I mean, Damien, do you guys have a perspective on that? That's a very mixed message coming out of the States.
It really is. I suppose, it really is. And I suppose that's one of the, fly in the ointment. It's a good news story that you have strong growth. It's a good news story that you're still getting economic growth a little bit ahead of expectations. The challenge is that it might give further buoyancy to that inflation, which is the challenge, and therefore I suppose mean that you might have more interest rate rises required, that it might take longer for interest rate cuts to come back on the table again. And so certainly from our perspective, we expect, like, because of a number of factors. In Europe, you've still got a war. In the US, you've got very strong job growth. The UK, across Europe, you've got still quite tight labor markets, which aren't really, like, despite the fact that you've got headlines of cuts in tech sector and stuff like that, tight job markets aren't normally associated with oncoming recession, and so therefore there is a slight paradox or slight contradiction within that. But I think it's just, it's where we find ourselves, and I think we are likely to see, like, I suppose to some extent it's a little bit less clear than we might like. But having a muddle through sort of, still get a bit of growth and not fall off a cliff with recession, despite the fact that you have, high interest rates, inflation is likely to be a bit stickier. Interest rates are likely potentially to stay higher than markets are currently predicting for a bit longer. And so, ultimately, where will that end? It will muddle through. It has led already to asset price adjustments. It is leading, presumably, businesses to make business decisions a bit differently. Tech, like the tech example is a case in point. Like they are cutting back on costs. They are cutting back on headcount. We're seeing it in pockets, and so there's no clear direction just yet, but that's okay. That's what you get at moments of inflection, I think, like this.
Yeah, absolutely. It has emphasized, I guess, that the nature of the tech industry, which is that it is, we now see quite a volatile industry, and following trends and so forth, which is interesting when it
I think one of the things that we've seen, Conal, and we've seen it across the what you'd call the tech industry, I've seen it across the stock market, is that money being free or very, very low cost for a long time has led to inefficiencies evolving, and being allowed to evolve in the marketplace and in businesses. Businesses were able to afford to have more employees than they needed. They were able to not be as profitable now as they should be, and still stock market pricing held them up because they had the opportunity to be future profits, and they had maybe some ideas. And I think, that increased cost of interest rates is just bringing a degree of focus to things. So tighter, higher costs and tighter monetary conditions are bringing a higher degree of focus. And what it should lead to is winners and losers. And it should lead to, better companies, better managed companies, better resourced industries and companies managing to see through some tighter times where maybe we might get, as Jeremy said, there might be further opportunities for insolvency practitioners. Unfortunately, that is likely.
Well, we'd sort of speculate whether it would lead to, when graduates are making decisions as to whether it would make the accountancy profession somewhat more attractive vis-a-vis the tech industry than heretofore. I don't know. It's too early to tell that particular trend, but that might have an impact on the entrance into our profession also, which would be
tech companies need
which are badly needed. Yeah. Right. Okay. And indeed, your advice is I would imagine applicable right across industry sectors, from the quoted right down to indigenous and so forth. I mean, this idea that you do needs to recalibrate your cost base in when you have higher interest rates, energy costs, staff costs, all of the above. It's going to have winners and losers. So people need to be cognizant of that. Jeremy, I'll throw it back to you. I think we probably need to be thinking about moving it along, but is there anything else?
I think, look, definitely, as Maeve said at the very start, the biggest thing we are seeing here is still a very tight labour market, and definitely the hiring for any size of firm, Big Four down to sole practitioner, very challenging. There is obviously, I suppose, ways that you can, and I know you guys putting kind of torn from different things. You try all the ways to even showing, as we mentioned earlier, sustainability, ESG. The new generation of worker will say, and I won't get into whether it's XZ or whatever else it can be, you need to show, I suppose, what you should share and part of your community and what you do and so on as well, and that can be a selling point too, and that's what they're looking out for compared to maybe the more traditional approach that would have been 20-30 years ago. But you're right, if there is any upside as opposed to a recession, and hopefully if there is such a thing, we hope that it'll be a short-lived recession. It could lead to a bit of a loosening in the labour market that might make the hiring of graduates and trainees a little bit easier for the accountancy sector. So that is the only silver lining you could see in a cloud there, and that could be an opportunity. Conal, you may have some further, before we bring this to an end, you may have thoughts as well on from the practice side of anything else you want to add.
I think I better not, Jeremy. We're well over time, so we're moving towards an end.
On that point of view, then, what I'm going to do is I'm going to thank both Maeve and Damien for taking the opportunity to join with us here today. And listen, I know we've had one or two people asking there about contacting the Members in Practice Committee. I think I described, if you click the link on the PDF, you have the names and you'll get to find, we haven't put in email addresses because that can be a sensitive issue on with relation to an open website, but you can find the details of the person by Googling them. They're on LinkedIn or their firm name, and they're all members, and they'd be happy to have that. And I think, Conal, there was another question there about the recording of the issues on a regular basis that's in the committee. That's something we can look at as well, I think, going forward, and getting that message out to work that's done by the committee more to the members in general in practice. So that's one we'll look at as well, and thanks for making that point. So listen, we're going to move on from this piece, but Damien, Maeve, thank you again for joining with us. I know we probably will be back again. I know Damien and Maeve, I'm sure, in the coming webinars or later in the year, and an update on these things, but great to have you both on board. Conal, I think our next area is we have our recording of from Leontia. Leontia, our UK tax lead, has been great to actually put together this very detailed recording of the issues, as I mentioned, making tax digital, giving that extra breathing room of 2 years. And also, I think there's definitely a rebalancing of the approach by the Treasury and by Jeremy Hunt, looking at maybe small practices and small businesses under 30,000. So Leontia is, if Chris, you can line up the recording, it's about 15 minutes, 20 minutes long. I know it's relevant to anybody with clients, even if you are based in the Republic of Ireland, in the UK, and have UK clients, it's relevant to you as well. So please do stick with us and have a listen to the recording, and we'll catch up with you at the end of that one.
Hello and welcome to the first UK tax update for Practice News in 2023. Hopefully most of you know me by now, but for those that don't, my name is Leontia Doran and I'm the UK Tax Specialist for Chartered Accountants Ireland. In this short recording, I'll be providing you with a brief update on what's been happening since our last update in December 2022 and what we as an institute have been working on for you, our members, from a UK tax perspective. So the key themes that I'll be going through in this recording are, firstly, look at 2022 and a number of successes that we had last year. I'm going to move on then to focus on making tax digital with an update on both making tax digital for VAT and income tax. We'll then look at recent work on EU exit, two miscellaneous issues related to HMRC services and the recent self-assessment deadline. And we'll round the session up by looking at a new consultation that we're seeking your help with and some simplification questions. So those are the key things we're going to be covering in the recording. Starting off firstly with 2022 and a review of the year just gone by. So because this is our first update in 2023, I thought I'd start off with a brief look at some of the key lobbying work undertaken last year and a number of successes that we achieved on the UK tax side. Overall, in 2022, we made 14 formal and informal submissions to the UK government and certain other bodies, including the Northern Ireland Department of Finance, on key tax matters. And that included themes such as the 2020-2021 self-assessment filing deadline, making tax digital, Northern Ireland corporation tax devolution, the potential for more tax devolution for NI, EU exit issues, raising standards in the tax advice market, and tax simplifications, amongst other submissions. We also had a key meeting last March with the President of the Institute, then President Paul Henry, and the Financial Secretary to the Treasury to get an update on HMRC's and HM Treasury's up-to-date views on Northern Ireland corporation tax devolution. But that work is currently on hold at the moment due to the ongoing political stalemate in Northern Ireland. But just to give you a flavour of the key successful outputs that we've had from lobbying recommendations last year. So firstly, we secured a filing easement for the 2020-2021 self-assessment deadline last January. We also had at the end of 2022 the announcement of a 2-year delay to making tax digital for income tax and a new phasing in for the smallest businesses, and we look at this in more detail later. And we also had HMRC's agreement to provide overlap relief information in the context of basis period reform. A 9-month delay to the introduction of the new VAT, late filing and payment penalties was also another recommendation of ours, which was implemented, and these rules commenced 9 months later from the 1st of January 2023. And finally, we secured a 1-year extension to the trader support service, although as you'll see later, we're looking for a longer term solution for the customs intermediaries market in Northern Ireland. A number of the UK tax recommendations that we made in the Institute's 2021 next financial year position paper were also achieved. And I guess overall the key message from that is that lobbying does actually work. Turning now to Making Tax Digital, firstly with Making Tax Digital for VAT. As we know, HMRC finally closed the online VAT portal from the 1st of November 2022 for most VAT registered businesses, unless the business is actually exempt from Making Tax Digital for VAT. However, just a reminder that businesses which file annual VAT returns are still able to use the VAT online portal until the 15th of May this year. So overall, the closure of the portal for most VAT registered businesses means that businesses no longer have to sign up to MTD for VAT. From HMRC's point of view, this is now no longer a project per se and is considered business as usual. But we're very aware that many smaller businesses may still be struggling to fully implement MTD for VAT. So please let us know of any specific areas of difficulty and we'll feed that back to HMRC. Turning now to the recent easements announced for Making Tax Digital for income tax. In our last practice news update in early December 2022, we were still awaiting an announcement from the government on an easement to the MTD for income tax timetable, and we were a little disappointed that this wasn't included in the autumn statement. That's because throughout meetings last year, we continued to reiterate the need for the government to take stock of the very challenging original timetable for MTD for income tax and to revise this to allow HMRC to reconsult with businesses and stakeholders and to also provide more time for HMRC, agents and businesses alike to prepare for this massive change. However, the easements that were announced included the 2-year delay in the timetable for implementing MTD for income tax and a phasing in for the smallest businesses. These easements were announced just a few days before Christmas when the Financial Secretary to the Treasury announced via a written ministerial statement in Parliament that the project will now commence 2 years later from the 6th of April 2026. As part of that, mandation is also being phased in for smaller businesses and an important review will be conducted by HMRC of the impact of MTD for income tax on the smallest businesses. So in terms of the phased mandation, this means that from the 6th of April 2026, self-employed individuals and landlords with an income of more than 50,000 and not £10,000 as it was originally will be required to keep digital records and provide quarterly updates on their income and expenditure to HMRC through MTD compatible software. Those with an income of between 30,000 and 50,000 will be mandated and will need to meet these requirements from the 6th of April 2027. Now, these particular changes to the timetable should give taxpayers and businesses and agents, of course, more time to prepare their client base and for the businesses and taxpayers to join the MTD for income tax trial voluntarily beforehand, of course, once the most suitable software for their circumstances has been chosen and implemented. So this should, in theory, allow them to take part in the trial for at least one full annual tax cycle before the relevant mandation date. And just to note that HMRC have signalled to us that it's likely that businesses that don't have a 5th of April accounting period end will be able to join the trial, but not until April 2024. Now, the review that's going to be conducted into the needs of smaller businesses, which particularly will focus on those under the £30,000 income threshold. That review will consider how MTD for income tax can be shaped to meet the needs of these smaller businesses and the best way for them to fulfil their income tax obligations. It will also inform the approach for further rollout of MTD for income tax from April 2027 onwards. Now, once that review is complete, the government have told us that they will set out any further plans or any further mandation of MTD for income tax, and of course we will be engaging with this review. Mandation for income tax will also not be extended to general partnerships in 2025 as previously planned, and there is currently no information on whether or not the government intends to delay the introduction of MTD for corporation tax, which HMRC had previously stated would not be mandated before April 2026. Although this given the other changes in the MTD timetable is also now likely to change. Basis period reform, however, is going ahead. So remember, this means that unincorporated businesses and landlords will be assessed on the tax year basis and not the current year basis from the 6th of April 2024, with 2023-2024 being the transitional year. Just to finally set out that in a recent meeting with HMRC, where the revised timetable and phasing of mandation was discussed in more detail, HMRC did confirm that the review into the needs of smaller businesses will not be a formal consultation, but it was also confirmed helpfully that nothing is off the table in that discussion, i.e. the review will also consider not just how, but if MTD for income tax is actually suitable at all for those smaller businesses with turnover under 30k. Turning now to EU exit. So we started the year by writing to HMRC to seek an update on 3 key EU exit issues: the need for a longer-term solution to the Trader Support Service, the continued lack of a duty reimbursement scheme, an update on the VAT legislation that will replace the VAT second-hand margin scheme for vehicles moving from GB into Northern Ireland, and an update on HMRC's current approach to customs and VAT compliance in the context of EU exit specifically, now that 2 years have passed since the end of the EU transition period. Now, we haven't had a full response as yet, and of course we will share that with you when we receive it. But in terms of the VAT legislation, HMRC has confirmed that in respect of the replacement legislation for the VAT second-hand margin scheme, this will now be introduced from the 1st of May 2023 and will be called the Second-Hand Motor Vehicle Payment Scheme. Where certain conditions are met, this will allow businesses to claim a VAT-related payment if they buy a second-hand vehicle in GB, England, Scotland and Wales, and subsequently move it to Northern Ireland for resale. HMRC is in the process of developing the guidance for this scheme and is working with stakeholders to do so through its Joint VAT Consultative Committee, of which Chartered Accountants Ireland is a member. And more recently, last week I attended the first meeting of 2023 of the UK-EU Trade and Cooperation Agreement Domestic Advisory Group, or DAG. Now, the UK DAG is a consultative body that aims to enable the government to hear from those affected by the operation and implementation of the UK-EU agreement. At that meeting, I took the opportunity to highlight our ongoing concerns that a longer-term solution is needed for the Northern Ireland customs intermediaries market, given that the Trader Support Service is due to cease on the 31st of December this year. I also raised the potential role that the DAG and its members could have in examining any proposals which may result from the ongoing political negotiations in terms of the protocol which are taking place between the EU and the UK, and also the importance of ensuring that business voices are heard as proposals develop. We also met last week with UK government officials, specifically the Foreign Commonwealth and Development Office, or FCDO, who are actually tasked with providing secretariat and executive support to the UK DAG. Now, although according to them the protocol is supposedly outside the remit of the DAG's work, we did receive an update from the FCDO on the ongoing protocol negotiations. The FCDO did confirm reports that the mood music is much more positive, but they also said that no framework or deal has been agreed because there's still lots of work to do on various areas. And that coincides with the comments made last week by the EU from Maros Sefcovic. However, the agreement on data sharing, which was reached in January, is viewed as being a positive step and a fundamental one in seeking to reach agreement on any future trade operating model for Northern Ireland in terms of the protocol. As part of our discussions last week, we also reiterated to the FCDO that it will be critical to involve external stakeholders early in the process to examine any proposals from a practical and business level. And finally, as usual, on this topic, if you have any feedback on EU exit issues, please do get in touch. Moving on now to miscellaneous, and I want to cover 2 related issues: the recent self-assessment deadline and HMRC service issues. Firstly, we're very aware that many of our members have been very busy in recent months, particularly in January, on the 2021-2022 self-assessment filing deadline. We'd love to hear from you about how it went, particularly in relation to your interactions with HMRC, the good and the bad. In particular, last month, you will know that HMRC was restricting access to the agent dedicated line to what it referred to as complex self-assessment queries. Please let us know the impact this had on your ability to file self-assessment returns. And finally, we remain concerned about HMRC service levels and will be discussing the current position with HMRC as their programme of 2023 forum meetings kicks off at the highest level this month. In order to do that, I would encourage you to get in touch and provide us with up-to-date feedback on your experiences. And finally, moving on now to a new consultation and how HMRC is going to tackle simplification. Firstly, in December 2022, HMRC published draft guidance ahead of the implementation of reforms to the UK's R&D tax relief regimes, which will take effect from the 1st of April 2023. Remember, this also includes a number of rate changes announced in last November's Autumn Statement. However, what we're currently focused on is a response to a new consultation on R&D, which was opened last month and which closes on the 13th of March. This consultation considers a possible single, simplified, as HMRC referred to it, scheme for R&D tax relief, which would effectively merge the existing large company and the SME R&D tax relief regimes into one. This single scheme would potentially apply as soon as next April and would be based on the large company R&D expenditure credit scheme. Note, however, that this consultation does not examine the rate of relief that would be applied under a unified scheme. And turning now to simplification. After the closure of the Office of Tax Simplification last month, when Finance Act 2023 received royal assent, HMRC is now being tasked with taking forward the tax simplification agenda. HMRC is therefore seeking feedback initially on 2 simplification questions and has requested that we circulate these to our members. So HMRC is keen to hear your feedback on the 2 questions set out in this slide. Firstly, what is your top priority for tax admin simplification which you think could be delivered within the next 12 months? And secondly, what is your top priority for tax admin simplification over the longer term? So we'd really like to hear your views on both the R&D consultation and the simplification questions. And finally, just a reminder that this recording gives an overview only of what's been happening and key work streams that we've been undertaking since our last update in December. Remember, you can keep up to date with all the latest Irish, UK and international tax developments through Chartered Accountants Ireland's tax newsletter, which we issue every Monday. And there's a link to subscribe to that on this slide, with a few other key links, for example, to our tax representation section on the website. And don't forget that next month on Wednesday, the 15th of March, is the spring budget, which will bring another Finance Act for 2023. As I mentioned, the first one was enacted last month and was quite short and contained a number of the Autumn Statement announcements. On Budget Day next month, we will be issuing a special newsletter highlighting the key announcements, and we'll be following that up in the next Practice News update in April with a more detailed look at the new tax and financial year in particular. And finally, the last thing for me is to sign off with a thank you for listening and some contact details if you want to get in touch to discuss anything further. Thank you.
I would like to thank Leontia as well for that very comprehensive update as ever. And it's great as well and that Leontia has asked there for if you have any particular issues with relation to UK tax to contact her. I know Leontia, with the different consultations with HMRC, Treasury and so on as well, values the members' input. So rapidly changing area, particularly making tax digital and so on as well, and a story that's going to keep on giving over the coming years, I'm sure. Listen, Conal, we're nearing the end. I know we're a little bit over, but we really did have a packed show today and so much covered. I know that we have 1 or 2 queries there. I know there's one I think that Garrod may have to take offline. There's a gentleman, Peter, is making some inquiries with relation to the PRSA. Garrod, you may have some thoughts, and I know it's tough. I think you probably may have to have an offline chat with Garrod, with Peter on that as well. But if you have any thoughts on that or any other questions, I know you're always behind the scenes typing away there, trying to answer questions. Please share with us as well.
Yeah, just quickly looked. There wasn't so many came in today. Just quickly before we go on to Peter's question, the just to note the grievances there with the reportable benefits and the reporting coming in there, and as I say, we'll continue to lay the revenue on that. Noting also the tax question there that came in from Stephen Brown, so we'll take that one offline and just raise that if we can at the appropriate time. On the point of the PRSA contribution, I think, Damien, to be fair, I might be have a look. I think you kind of answered as well as we could in that the Finance Act Section 22 subsection 1 makes a significant amendment to Section 118. In terms of Peter, the specific query here that's come in, I suppose we're limited in what we can say about the impact of that section because we can't give tax advice, and so that's just a limitation on us as a tax department, right? But what I can do is point to the legislation which to my reading of it does significantly change the existing rules. But again, as to how that's going to be interpreted by revenue, as you know, that's not for us to say, and we haven't as this hasn't come up yet, but this will be raised at the appropriate forum and talc. Again, to read a bit more into Finance Act Section 2022, if I look at Section 2022, I don't see a commencement date specific to that subsection. So therefore, it's the general commencement date that's contained toward the end of Finance Act. I think it's 108 or somewhere like that. Sorry, the exact section is gone. So that's as much of an answer we can give on that one, I think, without veering into tax advice. So again, we just have to be clear on what we can say, and just full clarity for everyone here. I don't think that's anything. But look, that's I suppose the main question that's come in. I think, again, to reiterate Damien's point there around you know, if you are going to go for making a 10-15 grand a year type payment or whatever, even if you're to orders of hundreds of thousands, perhaps more, again, the legislation seems to suggest that more contributions can be made. Now, again, you know, it is to talk to your pension advisor, and it is to consider that, you know, if from a holistic perspective, not just tax. But I hope that kind of gives that's as good as an insight as I can give at this point, without further discussion from revenue. And again, it seems to be a significant update, but again, it is down to how we interpret that section.
Well, listen, Garo, thanks for actually, and I know it's difficult here. Many different questions can come into you about wide and varied areas. As you say, this whole theme is PRSA. It's an evolving area. I know you're going to have further discussions at TALC and bring forward questions such as this, let's say, from the members' point of view to revenue. And I know, I'm sure, if you watch out for tax news on a Monday or tax news as part B news on a Friday, there will be further dates over the coming weeks on this. And of course, yeah, that's something that is, I suppose, relevant for so many things we cover here today. I know you're limited on the you're not a function that can give guidance and tax advice on a specific issue. That's for dealing with your own actual advisor in that area. But thank you, Gerard, for giving in as much detail as you can there on that answer. That's been great. Listen, Cornel, have we seen any other comments come in there?
I think we've dealt with pretty much everything. I know Gerard was working in the background on questions. No, I think we've basically dealt with them as they come in. So that, I think, is somebody did mention revenue pressed to open their phone lines again. Ridiculous, they're only open for 4 hours a day. That's fair enough. Okay, I think that Gerard has answered the others adequately. So hopefully that's you dealt with. So Gerard, thank you very, very much for staying with us. I think it's just yourself and ourselves here, Gerard, at this stage. But I see we still have 177 people on. You're
we do, and we won't keep people too much longer. As I say, this is a especially long show, but again, we have covered off so much materials. And I know actually Gerard is going to, in the survey afterwards, he mentioned that in his piece earlier an hour or so ago, that if you have any particular questions about issues that you see as particularly relevant for impacting you as a tax practitioner, to send them in as part of that survey, and they will come to Gerard and his team, and they will actually go through these to see trends and themes and things to carry forward with TALC as well. So that's another way of taking an issue forward to Gerard and his team. Listen, Cornel, I'm not sure, have we the slides there that we can get back up again? Maybe not, but in the slides, if you have a PDF of them, guys, we just have highlighted for you at the very end some other areas such as upcoming webinars, And we have a special link there at the bottom of all the webinars. We get asked on a frequent basis, you know, what are the exact practice webinars we have coming up, such as practice news, financial reporting, and also training to small and mid-sized practices. So we have actually a link there in one of our pages there. It's in the, I think it's slide 50 there. So actually this one, next one on the very bottom there, the CPD calendar, and also the actual, if you go back one slide, Conal, the actual practice webinars page. And listen, guys, even this is a kind of a kickoff really formally of our CPD schedule for the year. We gave a little break in January, and we know it's a very busy time. We have AML Essentials for your practice actually next Thursday, always a very popular course. It's Republic of Ireland and Northern Ireland. ISQM implementation, as I mentioned earlier, that update to help you carry it forward no matter what level of work you have done already at that next stage, which is on Thursday week. Then we've other ones into March, including the Going into Practice Day, Conal. And Conal, if you click ahead again, you will show the Going into Practice Day. It's one that's always very popular. I know I attended it myself about 10 years ago, long before I joined the Institute, and it's a great day for finding out, I suppose, the potential regulation involved, but also the ins and outs of actually and the insights, particularly offered by the practitioner, Amy Lee, we're delighted to have back again, and also Martin Adams on the insurance side. So really, if you are even thinking about going into practice, setting up your own firm, maybe you're going to be a partner in a firm over the next year or two, it's a course to come along to, or even if you're just maybe not in practice at the moment, but thinking of going back into it as well. Look, it's one that comes with, I think, 8 hours CPD too, so it's a great way of building up your CPD. So do check out the links on the previous slide. Only if you can click ahead again. Not sure have we much else in our pack there. Our thank yous. And I think we have our actual, and now for our thank yous here today, we'd like to thank, of course, all the actual speakers. So Dee, Susan, Mike, Gerode, Leontia for her recording, particular Maeve, and also Damien for the contribution, and Accuvest for their support as well. Pack show, I know, but listen, it's been very, very insightful. And also the team behind the scenes as well. I'd like to thank everyone in the CPD team. So Ian, Chris, of course, who without always sit at the background making sure everything goes off okay, and everyone, as I say, Linda and the team in CPD, and also as well, even just here to my hosts here in Belfast today, to Zara, to Karen, and to everybody else as well. Listen, it's been great, and it's been great to just have Maeve here live as well, as I say to you, for the show. Conal, have you anybody else or anything else to say to wrap up?
Absolutely, our own team in Practice Consulting. And I would like to acknowledge Bernie Walsh, who is retiring quite soon. Bernie has been a face of Practice Consulting for many years, and I'm not sure she's listening right now today, but she may well hear the recording. So thank you very much to Bernie for all the help she's given us over the years, and to all the team, and to yourself as well, of course, Jeremy, for everything you've done today. So listen, we'd better leave people go back to their Friday. So until then, until we see you again at our next webinar, or indeed at the next practice news. Thanks to everybody. Look after yourselves. Cheers.